Session. It seems some more of that might be coming into Europe, but this is the US futures picture. The US 2-year yield then currently at 4.68%, dropped by 16 basis points at one point yesterday. Such is the move into bonds, as we were talking about in the headlines. There's the weakness in the dollar, which was met with a little bit of strength in the euro just yesterday. We went above 110. Now we're at 109.84, with pretty flat actually on euro dollar. Tom, what do you see in the futures?
A bit of divergence coming through. You've got FTSE 100 futures pointing lower by 0.3%. DAX futures looking to gain at 21 points, so a slightly brighter picture being flagged by those German futures. CAC coherent is looking to lose about 9 points, down about 0.1% so far, at least on these futures, Anna.
Okay, so a mixed picture actually then on futures, maybe a bit of weakness coming through in London. Certainly that negativity over in the Asia session worth pointing to and asking questions about whether any of that comes through into the European session. For the moment, though, the bond column, the sovereign bond column, looks like what we were experiencing yesterday on Wall Street, where we saw yields coming down, in particular at the short end. We've got the German 2-year, the Spanish 2-year, the French 5-year yields all coming down a bit as we see bond buying, as we headlined for you this hour, talking about the amount of buying we're seeing in bond markets right now. Here's the selling on the FTSE 100 then coming to the fore, down by 0.3%. The euro retreating a little from some of those gains of yesterday that were really a dollar weakness story. So the dollar is flat, the euro down just 0.1% or so, but back down below that 110 level, which we went over yesterday. So 109.86 there. And here's the divergence then on European stocks. So yes, the FTSE 100 perhaps being overly influenced by some of that negativity out of the Asia session, but elsewhere, the Spanish IBEX, the German DAX, both of those making some modest to decent gains. We do see weakness on commodity prices. Perhaps that's something that's hitting London and its energy basic resource focus. Tom, what do you see on in terms of the sector picture?
Well, that is what's happening. We lift the hood on these sectors, and that is the drag on the FTSE 100 coming through from that energy sector then that you flagged, and are currently down 0.4%. Basic resources also taking a modest hit, off about 0.1%, and health down by 0.2%. Banking as well taking a bit of a knock, down 0.3%. So that factors into the FTSE 100, which as a benchmark here in the UK is down currently 0.3%. I was focused on technology because of that move into bonds and yields coming down. Tech as a sector gaining just 0.1%. A little bit more optimism coming through for financial services, 0.2%. And here's the German story then. Anna flagging the DAX and the move there, up 0.5% for the auto sector, and that is lifting the German benchmark by about 0.2%. Autos up 0.5 as a sector. That is a picture across these 12 main sectors. Across your benchmark, you are flat so far in Europe this Wednesday, Anna.
Okay, so flat at the overall index level on equities. Lots to talk about, though, when it comes to the macro story, and it's having an impact on FX, and particularly having an impact on bond markets. Let's just check in with what we've heard from Spain. The Spanish preliminary November CPI number rising 3.2% year on year. The estimate was for a rise of 3.7%. So if the direction of travel is downwards for yields, higher bonds prices and downwards for yields, then we're certainly not seeing anything that comes out of Spain that will change that thinking or push against that thinking. So weaker than anticipated CPI numbers coming through from Spain. So worth putting that into the mix, into the bucket marked drivers of weaker yields, perhaps. Let's talk to Sophia Horta-Acosta from the Markets Today blog to get us some analysis on this and other stories that they're covering on the blog. I mean, this just fits in with the overall pattern. We've seen it in the regional data coming out of Germany, these softer prints around inflation.
It really reinforces that narrative, doesn't it? I mean, I just want to really really point out, this is a slowdown in inflation. Spain has been the country in Europe that has had the least amount of inflation. So it's not the most problematic country when it comes to the Eurozone, but still really fitting into that narrative that inflation is indeed slowing. I think there's a really interesting divergence now between policymakers who are actually saying, hey, we've already raised interest rates enough to fight inflation, and those that are saying there's still a big fight ahead of us when it comes to inflation, and interest rates may have to rise further. So we could start to see some of that divergence in the market, and that's what happened last week between the UK and the Eurozone.
Yeah, these numbers out of Spain, I mean, we'll get to the Fed shortly, but these numbers out of Spain, month on month then, a contraction of 0.4%. The survey was for an increase of 0.1%. And as Anna was saying, 3.2% versus 3.6% year on year. When it comes to the Fed, and again, we reflect on the fact, one of our guests saying this is a game-changer moment for Christopher Waller, who's seen as relatively hawkish, saying he's very comfortable with rates at where they are because he's comfortable and confident you're going to get back down to that 2% target. And then you have Bill Ackman saying 100 basis points cuts by the end of next year. Maybe that's not as much. Maybe there's going to be more. At least it's going to come earlier than many expect. How are we thinking about that move into bonds and expectations around cuts?
So the market is still pricing in a cut only in June. So Bill Ackman's bet is very kind of much an outlier. There was another outlier bet, though. One trader pricing in 250 basis points of cuts next year from the Fed. So this is very much at the center of market thinking right now. You know, whether the Fed has indeed kind of run its course when it comes to fighting inflation. I think, again, what Anna has been saying, the narrative, anything that really feeds into this narrative will be taken by markets to kind of support this trade, especially going into the end of the year. Whether or not the Fed will push back against what Bill Ackman's saying, I mean, the first quarter, I think it sounds a bit too early, right? It's only been, we're likely to get a pause in December. That's what the market is saying. But cutting so soon after just pausing at that kind of peak rate kind of suggests that maybe the Fed, doesn't know what it's doing. So I think probably a higher for longer, just 3 months at that higher peak rate sounds a bit unrealistic.
Some of the weakness that we've seen in inflation, very welcome, obviously, and some of it driven by lower commodity prices. The forward-looking picture maybe looks a little bit more complicated. And I know we've got a story about UK fuel poverty in the UK. What's the story there, Sophia?
It's getting worse. It's getting worse. So currently, this is an estimate from the government or regulators here that right now, so 6.3 million UK households are currently in energy poverty, and that's probably going to rise to 6.5 million from January, and that's because we have that increase in the price cap from Ofgem. Really, this is a huge challenge for plenty of UK households who are now actually using tactics to reduce their energy consumption. And this is a story that can't be ignored. I mean, now we're talking about, it's very cold right now in Europe, and it's set to be a cold winter. So how this will impact and feed through to household consumption, household spending, especially when you have people talking about a resilient UK economy. Can it continue to be resilient when UK households are still under a severe amount of pressure? I mean, we're talking about fuel poverty here, not just people who are struggling to pay their bills. So this is a very extreme case in the UK.
It still is a bit of a head-scratcher, isn't it, in terms of how resilient the UK consumer is amid this cost of living crisis. But switching focus to another part of your wheelhouse, a story that you know very well, which is China and the role of Alibaba in that economy. And Jack Ma, the head, of course, the former head, I should say, kind of stepped down, but coming out and making some comments in an internal chat, it seems, in Alibaba, and saying that they need to kind of pivot the business, but he's still ultimately confident. This is quite significant intervention from Jack Ma, who we haven't heard from quite a while.
It is, and it really surprised employees at Alibaba. This is a stock that hasn't done well at all, and actually Jack Ma shelved his plan to sell his own shares because the stock price had fallen too much. So clearly he sees some urgency for change at the company. So what he said is essentially, he praised his rivals, PDD, a big rival of Alibaba, which is unusual, and said that Alibaba will need to change and correct its course. Those were his exact words. He didn't exactly specify where Alibaba could focus in terms of changing its course. But again, it really shows that, even Jack Ma, who in the past 3 years has been in the background, really wants Alibaba to do something to kind of fend off competition. It's growing competition in China.
Okay, Sophia Horta-Acosta, thank you very much indeed across a number of these markets themes and the story around Jack Ma and Alibaba. You can get more, of course, from Sophia, the rest of the team on the front page of the Bloomberg UK website, or by typing TLIV GO on the terminal. Now, we touched on this, and we're going to get more reaction. Federal Reserve Governor Christopher Waller on whether he thinks policymakers have done enough to curb inflation. Get me more details in the next few minutes. Stay with us. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Markets Today, 11 minutes into our European trading session. We see underperformance on the London market, some of the banking names, some of the energy names in focus today to the downside in London, and that's weighing on the London market. Elsewhere, better performance across European stocks. Let's get a check on some of the individual movers, though. Joe Easton from our equities team has a briefing. Joe.
So the biggest decline at the moment, Anna, is Philips over in Amsterdam, dropping around 7%, coming down to around 6% now. A sucker punch from the FDA in the US last night, announcing potential overheating in some of their sleep apnea devices. These were already part of a bigger recall that Philips has set around €1 billion aside for in order to pay for some of the repairs there. So another blow for them. But over in Poland, we've got CD Projekt, the games maker. Cyberpunk still performing well. That stock rising 4% following earnings from then. And Ferrovial following this controversial sale of a stake in Heathrow Airport to the Saudis, and also a private equity firm. That one getting a boost over in Spain, worth around £2.8 billion, according to the statement from them. A big gainer over in Helsinki is Musty. Now, this is pet care, pet products, vet services, all that kind of thing. They've got a takeover offer, a massive premium, and that one rising around 9% at the moment. I feel like I should do a pun on the pets one. Investors purring at that one. Could say maybe barking up the wrong tree there, but we'll flip over and move on from those before I do any more. We've got Harbour Energy. Now, this one over in the UK smaller cap oil space, reiterating their guidance. There was investor concern that they would have to cut that given some weakness in some of their end markets, but that not seen. That one gaining today. And a big dropper is Halfords, warning in a statement today that people are cutting back on big ticket items. It sounds like bikes, that kind of thing that did really well during the pandemic now is easing in terms of their sales. So dropping 22%, the worst performer across the entire London market today. One stock declining in Germany is Aroundtown, the real estate firm. Unsurprising, really, the rising interest rates weighing on some of their asset valuations. There are concerns around capital raises in German real estate. Not seeing that confirmed, but the earnings are weak and the asset valuations, as I say, hitting Aroundtown today. We brought up Saipem, the Italian energy company. They've got a couple of new deals over in Africa announced this morning, a couple of $1 billion for them. So that one getting a boost over in Milan today. In terms of those ones we had in stocks to watch on the ratings front, we've got Campari downgraded to underweight at JP Morgan, the maker of Aperol Spritz. It's far too cold for Aperol at the moment. Maybe that's partly to do with it. But JP Morgan says the market is weakening in the US following that warning from Diageo a couple of weeks ago. They prefer beer makers and upgrade Carlsberg. That one getting a small boost in comparison to the underperformance for spirits. And we've got Kindred, which is in gambling over in Stockholm, exiting North America following weak sales for them. Finally, Vestas gets an upgrade over at Berenberg, which says their margins are improving. That one in the wind space boosted this morning.
Joe Easton, thank you very much indeed. Our producer might not want to, but I'm very comfortable pausing on your pet puns. Joe Easton, thank you very much indeed from our equities team. Let's move on from that and to the Fed and comments from Governor Chris Waller saying he's encouraged by a recent slowing of economic activity, which he says may indicate policy is tight enough to contain inflation. Take a listen.
I'm increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
Fed Governor Chris Waller speaking in Washington there. Joining us now is Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, your take on the comments that we heard from Chris Waller, and a line that stood out from your notes for me was you think that rates will be cut, but think that they're going to happen later, but maybe come in deeper than the markets expect. Unpack that view in light of what we've been hearing from Chris Waller, someone who's been seen as a hawk.
Yeah, absolutely. I mean, I think that's one of the critical decisions investors need to make from here. We're all comfortable we're at the peak. But are they then going to cut preemptively before we see weakness in the data, or will they be cutting reactively? I think they'll be cutting reactively once they see the weakness in the data. And I don't think his comments sit against that. I mean, what he just said there was the current stance of policy is correct because the activity is weakening. So the central banks, I still think, need to see weaker data to be confident that their battle against inflation is won. They need to see the service sector of the economy slowing. They need to see the labour market just softening off. Because I think the risk is if they start turning dovish too quickly, with unemployment still at record lows practically everywhere, there's a real chance that they've declared victory too early and we get a resurgence.
And even if we see those things, Karen, but we don't see inflation coming down to target, I suppose that also plays into your thinking about how long rates stay at these elevated levels for.
Yeah, I mean, I would say over the course of the year, there's no doubt that we've had good news on inflation, which has removed that left tail risk for us of investors, which was this idea that inflation would be stuck so high they couldn't react if the economy was really crumbling. That sort of persistent stagflation, that risk has diminished notably, and that's really positive for risk. However, I think the idea that we're truly back in Goldilocks, that these economies can maintain growth or even accelerate from here, and that also be consistent with getting back to 2. That's the part that for me is a little too good to be true and keeps me a little hesitant, because I think the market is increasingly, as it has many times over the course of the year, tried to nudge back towards that Goldilocks view.
We've been assessing the order of the central banks and when they move, who moves first, and you're putting the Fed towards the back end of next year. Where does the ECB land in that? I mean, the data out of Spain, again, and the region in Germany, in terms of North Rhine-Westphalia, coming in softer than the surveys. Both sets of data softer. Yep. The inflation picture in Europe is heading in the right direction. The economy is soft. Does the ECB go in the first quarter?
No. The first quarter? No, absolutely not. No, I mean, it comes down to, again, I'm picking what's going on with inflation. There's no doubt energy prices are down, goods prices are really softening. But it's this underlying inflation which comes from the service sector and comes from wages, where I think it's far too early, particularly in Europe, to be really confident that that's where the work is done. We're going to go through some really keen wage negotiations in the first quarter. They'll be wanting to see the evidence of that. And that's when I think, you know, if however, and again, this comes back to the point where they can react if the economic data really crumble. If we're seeing a rate cut in the first quarter, it's because Europe is once again taking a turn down. But that's not what the activity data is showing us on Europe. It's suggesting we're at a bottom, possibly even re-accelerating. So no, Q1 looks far too early for me.
OK, so maybe later in the year we get to that conversation. Where does that leave us on bond markets? Because to Tom's point, we've seen this data on inflation all coming in softer than anticipated, regionally in Germany and in Spain. And then this is sort of picking up on the same themes Wall Street was dealing with yesterday. And so we see yields going lower and lower and lower. So what's the bond strategy looking like for you?
Yeah, so the bond market is desperate to get these cuts going, isn't it? I think that the bond market's looking for cuts a little too early, but when they eventually come, they will be larger. So although I'm hesitant on calling these rate cuts coming early, I'm still very optimistic on bonds, because ultimately I think it'll be later and then deeper, and that will still mean that bond yields head lower when you need them to. And I think that's the really critical point for multi-asset investors at the moment in thinking about why you're adding bonds. It's not just the income they're providing you on the US market at 4.5. It's the diversification they're providing you if things go wrong. If you've got a US 10-year in your portfolio now, and actually the consumer finally crumbles, we see what usually happens in the US, which is everything's fine until it's not, then if that 10 years down 200 basis points, you're going to make more than 20% on that bond. So it's the insurance that you're getting from bonds, which I think is what's making them most attractive to me.
The equity markets then this month posting the best gains globally since about November of 2020, and part of that is down to the money moves into bonds and yields coming down. Does that momentum feed into and continue into 2024? Is there more upside for this equity rally? And if there is, where do you want to position?
No, I'm a little cautious because, as I say, I think that where once again the market is getting a little carried away is on this idea that the central banks will be preemptive and stem off any weakness. So we're at the bottom of activity and things, if anything, will re-accelerate. Earnings expectations for next year are more than 10%. That's on expansion in margins as well as top line, when we've already got very high margins. To me, it seems very inconsistent to have the story of inflationary pressures are coming down and margins are expanding. Unless you think costs are falling through the floor, I struggle to square that circle. So I'm a little cautious on valuations from here. Not wildly so, not horrifically bearish, but I would just want to be tilting very much towards the quality spectrum, such that when that weakness in earnings come through, you've got the good companies who've got solid balance sheets, who've been through recessions before, and they'll be the ones that I think are most resilient.
Karen, thanks very much. Thanks for joining us. Good to speak to you this morning. Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. We'll have more on the markets after the break. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
On the next episode of the Business Week Show, imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
This is Markets Today. Happy Wednesday, 24 minutes into the European trading day. Bonds bid, equities bid, unless you're here in the UK where the FTSE 100 is down about 0.4%. S&P E-mini is though pointing to positive territory, currently up 0.1%. Now, Berkshire Hathaway has announced the death of longtime Vice Chairman Charlie Munger. He was 99 years old. Warren Buffett honoured his right-hand man, saying his inspiration, wisdom and participation helped shape Berkshire Hathaway. Here's a look back on his life and legacy.
Charles Munger served as alter ego, sidekick, and foil to Warren Buffett for almost 60 years as they transformed Berkshire Hathaway from a failing textile maker into an empire. A lawyer by training, Munger helped Buffett craft a philosophy of investing in companies for the long term. In 1962, the two men began investing in Berkshire Hathaway, a Massachusetts company that made men's suit linings. Even after the mills closed, Berkshire stuck around as the corporate vehicle for a growing conglomerate of companies. Focusing on businesses with strong brands and pricing power, Munger nudged Buffett into acquiring California confectioner See's Candies in 1972. The success of that deal inspired Berkshire's $1 billion investment in Coca-Cola stock 15 years later. At the company's annual meetings in Omaha, Nebraska, where he and Buffett had both grown up, Munger was known for his roles as straight man and scold of corporate excesses. The acerbic Munger so often curbed Buffett's enthusiasm that Buffett jokingly referred to him as the abominable no man. Still, for many years, Munger was more bullish than Buffett when it came to investing in China. His purchases of stock in Chinese automaker BYD resulted in Berkshire becoming that company's largest shareholder. And even as his partner became a worldwide celebrity, known far and wide as the Oracle of Omaha, Munger believed Berkshire's success would outlast Buffett's star power.
In my opinion, Berkshire will flourish after Warren's gone. I don't think anybody is essential given the momentum we now have in place.
He didn't overstate his own importance either, sharing his vice chairman title at Berkshire in 2018 with two next-generation senior executives, Greg Abel and Ajit Jain, and affirming the company's commitment to a succession plan.
baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top stories. Global bonds march towards their best month since 2008. The dollar continues to slide as investor Bill Ackman says Fed cuts may come as soon as early next year. German CPI is expected to fall after a key region showed prices cooling further in November as the ECB balances slowing inflation with negative regional growth. And Spain's consumer prices unexpectedly come in softer than expected, largely due to falls in the cost of fuel and tourism. Tom, a lot of macro movers then today, and all seem to be pushing in the same direction. Lower yields, the story in the US in the last 24 hours. The German and the Spanish data adding to that theme.
Yeah, we're seeing yields dropping across the Treasury curve, but also in Germany and in the likes of BTPs over in Italy as well. We had a redhead crossing the terminal just in the last few minutes. ECB regulators, several ECB regulators from the Central Bank of Europe, of course, planning to push to ease bank payout stance. So it seems like some regulators, at least a mix amongst them, are pushing to ease the restrictions around how much banks can pay out in dividends. We'll get more on that. We'll follow that story and flesh that out for you in the next few minutes. So we'll check in on the banking stocks of Europe as well. Across your main index here in Europe this Wednesday, you're looking at very marginal gains after the losses of yesterday. The DAX, though, is having a better session, adding 50 points, up 0.3%. And the auto sector is a key reason for that. It's one of the leading sectors so far this morning. Obviously benefits on the back of lower rates. And you see yields dropping again in the session, as we mentioned. The FTSE 100 is a very different picture, though, here in the UK. Down 0.6%. And again, it's part of the rate story, but for other reasons. So the banking sector dropping. We'll see if these loans out of the ECB change anything for Eurozone banks. But the FTSE 100 having a bit of a miserable day. Energy is also weighing on that sector. 7,409, looking at that 7,400 level for the FTSE 100. Let's have a look then at the sectors and how it's shaping up. There's divergence, certainly, amongst these sectors this Wednesday, midweek. And the standouts as they come so far, 30 minutes into the trading session, basic resources gaining 0.6%. But the pressure, that's here on the UK, coming through from energy. 0.8% is the drop there. We look ahead to OPEC Plus and that meeting and whether or not cuts will come through on Thursday. Insurance, this is also dragging on the FTSE 100 down 0.8%, also not benefiting as yields drop. In terms of the upside, that's coming through from financial services, 0.4%, but really technology. And as I was flagging this before the start of the open, of course, on the drop in yields, a benefit for that sector, and that's really coming through now. It's quite pronounced. Tech is gaining 0.8%. And for the DAX, the auto sector, really big lift there. That sector gaining a full percentage point. Banks down 0.3%. That's another downside pressure for the FTSE 100. The strength coming through from technology, the strength coming through from autos, the downside on banks and energy. Across your benchmark, benchmark. Very modest gains of 0.1% in Europe, Anna.
Yeah, certainly clear to see that the banking sector has bounced off earlier lows on that red headline around the ECB that you were just mentioning. We'll look for further details on that then, Tom. Let's move on to the UK investment case. On Monday, the UK Prime Minister Rishi Sunak hosted the Global Investment Summit in London as part of his government's latest attempt to secure investment. Now, foreign direct investment into the UK has fallen by more than 25% since 2016-17. Joining us now is one of the investors who was, I think, at the summit and certainly an investor in the UK, Bob Faith, founder, chairman and CEO of the global real estate firm Greystar. It's invested more than £11 billion of private capital into the UK since 2013. Very nice to have you with us, Bob.
Great to be here.
Good to have you in the studio with us. So let's start on the investment case in the UK then, because you clearly have exposure already, investing around all kinds of rental property in the UK market. Yeah. What do you see as the outlook in the UK?
Well, actually, I think, what we heard a lot about at the investment summit was the UK remains a very exciting place to be going forward. I mean, I think the fact that we were there is the recognition that there is a housing shortage, in the country, and it's going to be institutional capital that's going to have something to do with solving that problem. And so we were excited to be there, excited to talk to the various government officials that were there about the part that institutional capital can play in starting to get the supply pipeline going to try and help solve that housing crisis that we have here.
What are some of the barriers that you face to boosting investment in the UK? What are the conversations you have with regulators, with officials, when you say we need more of this and we'll invest this much more?
It was interesting. I was standing there talking with one of the heads of BMW that's doing their plant up by Oxford that they're building, and it's regulatory slowdowns. And he said, "Oh, I got an email from an environmentalist that I had to stop my building of the plant because of X, Y, and Z." It's the same thing across the different kinds of investment, whether it's the green investment, those folks who were there talking about some of the regulatory. It's pushing through kind of the regulatory processes so that we can actually get things started and, start to create the things that are going to solve the problems that the UK has, housing shortage being the one we're focused on.
So focus on planning is something that the government talks about, but maybe we haven't seen all that much of a shift. We might end up with a different government. Do you get any sense of what a Labour Party would mean? Because perhaps they'd want to see more house building, but not necessarily of the variety you're describing, or maybe. What are you hearing?
Actually, we're just part of the solution. We're building purpose-built rental housing, which is really just part of the solution, but it's something that the UK hasn't seen. I mean, in the US, where we started our business 30 years ago, it was kind of like the UK is today. Institutional ownership of rental housing was not really a big thing. Today in the US, institutional owners own 40% of the rental housing. In the UK today, that's 4%. So huge upside, for institutional investors to get into the rental house, and we have to build it. And so that takes a little while. So this is a long-term solution, but I think it's something we can do. I mean, we heard a lot of results from, the focus that the country had on getting to net zero, and then the impact that's already been in place, by getting focused as a country on that. I think it's the same thing. I think both parties share that commitment to solving the housing crisis. I mean, because roofs over people's heads, it doesn't get more basic to voters than that. And I think that is something that people can agree on. Well, but it's going to take all kinds.
And the housing crisis is real. The Labour Party, they kind of walked back. They did a U-turn on rent caps. It's something that they flagged.
Right.
But the Labour mayor of London Sadiq Khan says he'd quite like to see rent caps. Would that concern you?
I'd say that, there's all kinds of, we operate all around the world in every kind of regulatory environment, as you can probably imagine. And I would say that we will be able to find a way. The problem with rent caps are if they cap revenues in a way that doesn't keep up with the expenses, you can often see, that's what creates slums. I mean, that's what creates, where revenues don't grow with the expenses, and then investors, slumlords quit investing in the properties. That's not what an institutional investor wants to see. And I think both sides of the aisle really understand, you can't create a situation for institutional investors to get caught, but nor does there have to be kind of, runaway, upside either. And so I think as long as it's a fair regime, we will find a way to operate. I mean, because we're a long-term investor, our investors are long-term investors in this space. And I think a fair regime is what we'll be talking to the, government about.
Are there geographies where you see dynamic caps in place that work then for all parties, do you think?
Yeah, the Netherlands is an interesting market. We're a big operator, of student housing and rental housing, in the Netherlands. And I would say the regulatory environment in the Netherlands is very dynamic, and the government's very responsive to trying to make sure that the regulations, have a fair deal for the owners, but have a fair deal for the renters as well. And so as long as you don't just sort of set it and forget it, yes, there's many examples of sort of regulatory environments that can work, and can take care of the landlord and the renter as well.
And you talk about the Netherlands there, jumping jurisdiction to Germany. There's a lot of distressed assets, real estate assets in that country. We saw Adler down or taking a kind of close to €1 billion restructuring hit just yesterday. Are you looking with appetite at picking up some distressed assets in Germany? Is that an interest that
we do? We have an office. We have operations in Germany as well. And you're right, that's probably the most distress in Europe right now. And so we are very closely looking through a lot of situations. I think there will be some interesting opportunities. You had some investors that took too much debt when it was cheap, and it's not cheap anymore, and oftentimes that creates opportunities.
Yeah, I think we've seen a report this morning from AEW saying that they've seen a bottom in the real estate market in Europe. Does that fit with your assessment?
It does fit. If you think about it, your guest earlier was talking about, potential for a bond rally. In a lot of ways, real estate operates a lot like bonds. It's a long-term stream of income that does grow with inflation. And so if we see the rate environment start to move down, that's going to be a very good thing for real estate.
How have you navigated that higher rate environment? How much of a drag has that been on your growth over the last few years?
We're fortunate. Most of our investors, we are a lower leverage investor. We have long-term time frames, so we have the ability to kind of move through, and actually often times of distress are some of our times of greatest growth. And so I think that, having the stability of long-term institutional investors has really been a key to our success.
Yeah, what is the wider sort of attitude of investors towards real estate at the moment? Have you seen, in Europe, I guess we're talking about now, have you seen a lot of people getting out of office space and wanting to get more exposure to housing? Is that part of the overall trend?
It's absolutely part of the overall trend. I mean, we're really focused on, kind of rental housing has a huge demographic kind of, tailwind behind it. I mean, the urbanization of cities, the movement of the populations to the great cities of the world, and a shortage of housing really in every great city, around the world. And, I think institutional investors see that. They want to allocate more capital to rental residential, but there's a real slowdown in transactions. So to get out of office and to be able to move to rental residential when there's just no trades going on, it's going to take a little while, for that to happen. On the other hand, rental housing mostly has to be built in most of the markets here in Europe. And so that takes a while to deploy that capital as well. So it will shift. It'll be a slow shift, though.
Okay, really interesting insights. Bob Faith, thank you very much indeed for joining us in the studio this Wednesday. Founder and chairman, CEO of Greystar. Thank you. We'll be right back. We'll get more on these markets. Stay with us. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 8:44 here in London. A bit of divergence, actually, across European equity markets. Weakness in the London market, some of it related to the banking sector, to energy markets. Some better performance elsewhere. Certainly the Xetra DAX up by 0.7%. So divergence across Europe is the theme. Let's bring you another story, though, away from the day-to-day moves in markets. Berkshire Hathaway has announced the death of its longtime vice chairman, Charles Munger. He was 99 years old. Warren Buffett has paid tribute to his right-hand man, saying Berkshire Hathaway could not have been built to its present status without Charlie's inspiration, wisdom, and participation. Let us speak now to Bloomberg's Charlie Wells, who's been following the career of Warren Buffett and Charlie Munger and the fortunes of Berkshire Hathaway for a long time, and can give us reflections. Charlie, good morning to you. So talk us through what should we remember, I suppose, about Charlie Munger, right-hand man to Warren Buffett?
Well, look, if Warren Buffett was the oracle of Omaha, Charlie Munger was his architect. And in a lot of ways, he helped build the firm that has really become the epitome of the rise of American capitalism in the 20th and 21st century. Now, they met, Charlie Munger and Warren Buffett met in 1959, but they actually have the same hometown, Omaha, Nebraska. And actually, Charlie Munger worked at Warren Buffett's grandfather's grocery store. And those historical ties, the decades that they spent working together, really developed a trust between these two men that created a business partnership that is to be envied, and returns as well that really look almost impossible to repeat.
And Charlie Munger had his own set of fans as well. He used to call them groupies. What were the principles that he lived by, that he invested by, that made him so wealthy, that worked out so well for him?
Well, a lot of this goes back to poker. And Charlie Munger was actually deployed to Nome in Alaska during World War II. And he learned to play poker there. And he talks about how that game really taught him a lot of business principles that he brought into play over the course of his career. And it folded down to two things. I mean, if you need to fold, if the odds are against you, fold early. But if you have the edge, play that edge hard, because opportunities come around so rarely. And so those were guiding principles. And he really helped kind of steer Warren Buffett's thinking in investing. So before Charlie Munger came onto the scene, Buffett really thought about finding undervalued companies. Charlie Munger really brought the sense that, don't just look for wonderfully priced but fair companies, look for wonderful companies at fair prices.
Yeah, absolutely. I thought that quote was really interesting. We've got some great pieces on the Bloomberg Terminal this morning going through some of his great quotes from that on that value investing, the nuances, I suppose, in value investing. Really interesting. What does his death mean then for Berkshire Hathaway?
Well, look, he brought to Berkshire this sense of trust that we were talking about that's so important. And I think when it came to hiring, there was a sense that it was trust first, ability second. Now, that sounds a little bit bad, but it was one of those statements that made Munger famous for just speaking to the truth. And there is, there's been a lot of debate about succession planning at Berkshire Hathaway. Of course, there's a successor plan for Warren Buffett. That's Greg Abel. Ajit Jain is also, mentioned often in discussions about the potential leadership of Berkshire Hathaway. But look, if you invested $1,000 in Berkshire Hathaway in 1964, that investment today would be worth $10 million. And it is just that level of return that I think will be difficult. And I think Charlie Munger played a huge role in bringing about that level of success.
Yeah, fascinating biography. And of course, the returns speak for themselves. Charlie Wells on Charlie Munger. Thank you very much indeed. Coming up, the rally in Treasuries has further to go. We're seeing that again today as expectations that the Fed is done with policy tightening continue to ramp up. That is the view of Ven Ram from our MLive team. We're going to get more analysis from Ven in the next couple of minutes. Stay with us. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is markets today, 51 minutes into the European trading day. You're seeing the benchmark stock 600 up 0.3%. So a bit of optimism coming through for European stocks as yields drop across the Treasury curve and across the Eurozone as well. US futures pointing to the upside of about 0.2%. One individual story that is jumping out, not good news again for Philips. That stock currently dropping around 6%. That's after the US drug regulator, the FDA, cautioned the public about an emerging safety issue regarding some of their treatments for sleep apnea, talking about overheating, reports of overheating. Barclays, the analyst there, saying that fresh concerns from the FDA over overheating devices are, quote, unhelpful. Yes, to say the least. So that is impacting Philips. That stock currently down 6%. Anna.
Okay, yeah, Philips and sleep, not been an easy relationship in recent years. Let's get to some of the other top red stories on the Bloomberg terminal this morning. Amazon is rolling out a workplace chatbot called Amazon Q. It is designed to help corporate customers search for information, write code, and review business metrics. Amazon Web Services, the company's cloud computing division, is adding generative AI into more products to reclaim ground in a field led by its main rivals. Microsoft and Google have announced similar moves.
Uber has struck a deal that will see London's iconic black cabs on the ride-hailing platform, following similar agreements with drivers in Paris, New York and Rome. London's cabbies vehemently protested Uber's arrival in the city, with 8,000 taking part in a demonstration back in 2014. The move is part of an expansion by Uber that allows users to book intercity trains, the Eurostar and car rentals.
Morgan Stanley is fighting to overturn a French court ruling after it was ordered to pay 1.4 million euros in bonuses to a former banker who quit. Former employee Bernard Mourod's lawyer argued his client's bonuses should be paid, with the bank arguing they were only due if he'd stayed on. The case could affect attempts by investment banks trying to prevent their best performers leaving their jobs.
Right, let's get back to these markets then and bring in the analysis of Venram from our M-Live team. And Ven, you've been talking about the upside coming through for stocks, but also gold, as markets, investors increasingly price in a pivot from the Fed. Does the upside continue?
Yes, I do think that the upside continues for now, Tom, because we are now in a tactical rally. We saw the tactical rally start with the October CPI data 2 weeks ago that came in slower than forecast. And then now, yesterday, we heard from Christopher Waller saying that, rate cuts are on the table if the disinflationary process continues, if the data is consistently pointing in that direction. Now, that's a big if that data will indeed consistently tell this narrative of disinflationary process. But you've got to take him at his word, and therefore the markets will rally, albeit I do think it's a tactical rally. We haven't seen a consistent disinflationary process in the second half, And therefore, I don't think that we are going to converge to, say, even a 3% PCE core inflation rate anytime soon. Therefore, the markets are getting ahead of themselves. They will get ahead of themselves in the next few days, particularly going into the PCE data tomorrow.
Okay, so where does that leave us on bond markets then, Ben? We've been talking about the big rally we've seen in bonds, the way yields have been coming down, in particular at the short end, reflecting what we heard from Christopher Waller. Where do you see the bond markets moving from here?
I do think that there is plenty of upside for duration here from here because, it's clear that the economy is near an inflection point. At least in terms of the inflationary narrative, the labor market is also coming into balance. So the inflection point is pretty near, although we can't say it with any pinpoint precision. But having said that, I do think that it's going to be a waiting game for a while. So therefore, it would be foolhardy to bid up the front end just yet.
Ben, what do you make of the inflation data coming out of Europe, Spain, Germany? Is the ECB, does it now have a gap in the door to also consider cuts to the main rate from the European Central Bank as you weigh up that inflationary picture out of the Eurozone?
All that we have heard from Lagarde and all the people on the governing council is that, look, it's too premature to talk about rate cuts. Yes, inflation is kind of behaving itself at the moment, but, also one of the other things that they are looking at is the labor market strength, and the jobless rate in the Eurozone is at pretty much near a record low, and that will give them confidence that they can hold rates higher for longer. So the markets are, of course, pricing in lots of rate cuts in the next year from the ECB. I think some of that will come through, but not a whole lot. Maybe 2 cuts from here.
Ben, thanks very much. Ben Ram from our Markets Live team. Remember, you can get up-to-date analysis and insight from the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. His thoughts there on the ECB, tying in with what we heard from Karen Ward earlier of JP Morgan Asset Management, talking about maybe the market is expecting a little bit too much early on from the Fed. And certainly we will focus in on that in the light of what we heard from Christopher Waller and also Bill Ackman. Now, still ahead, we'll get back to the energy conversations, discussing energy security with Jeffrey Pyatt, the US Assistant Secretary of State for Energy Resources. Stay with us for that exclusive interview. That is it for Markets Today. You can get insights from us and the team that puts together the Bloomberg UK website. That takes you through to the Markets Today blog. The Pulse is up next. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global bonds march towards their best month since the financial crisis as expectations grow that the Fed is done with policy tightening. German CPI expected to fall after a key region showed prices cooling further in November. We'll bring you the latest figures in just a moment. And Charlie Munger, who helped Warren Buffett transform Berkshire Hathaway into an empire, has died age 99. Now let's have a look at what the markets are telling us this morning. Treasuries seem to be extending a lot of the gains that we saw. There's definitely a clear pivot for the Fed that's being priced in more and more. Now, European equities, U.S. futures seem to be edging a little bit higher. If you look at, the mixed session that we had in Asia, I'm also looking at German bonds. So we're getting some of the CPI inflation data very shortly, but German bonds heading for their longest streaks of gains in more than 4 weeks. Again, as state data is showing that inflation is continuing to slow. Then we look at dollar, always, a dollar dropping for a fifth day. If you look at bonds, overall, they're rallying at the fastest monthly pace since 2008. Again, the story is one of billionaire investor Bill Ackman, the latest one to bet on Fed cuts, and he thinks they could come as soon as the first quarter earlier than the market pricing seems to be suggesting. Now, we're getting the breakdown of German CPI, Bavaria November CPI rising 2.8% year on year. If you look at Saxony, those prices rising 3.9%. Certainly year on year, it's much lower than we had in the last couple of quarters. So let's get the details with Bloomberg's Oliver Crook in Berlin. So Ollie, good morning. What are the CPI prints actually telling us?
Yeah, so we're just pouring over them now. So we have Bavaria, Saxony, and Hesse that all just came out. So Hesse and Bavaria have made it easy for us. That's down 0.4% month on month. So that is disinflation here in Germany for the two key regions there that together are worth almost 30% of German GDP. North Rhine-Westphalia, which we had earlier today, was down minus 0.3%. So these are substantially lower numbers that we've been seeing. So this is all very sort of encouraging. The headline number that we're expecting in a couple of hours' time is year-on-year 2.5%. That would be the lowest reading of German inflation since June of 2021. When we look back in the last month in October, what was really driving prices higher? It was still consumption, entertainment, alcohol, and going out. The sort of consumer side of it, energy was sort of moving in the other direction. What does it mean for rates? It depends who you ask. But if you ask the Bundesbank, Nagel, he was just saying yesterday that it is way too early to even begin to think about talking about lowering interest rates. They really need to see the read-through all the way.
Yeah, I thought that was really interesting because, so first of all, tomorrow is the big one, right? We have Eurozone inflations, and they're also expected to show only a decline in inflation. But it was interesting to hear Mr. Nagel actually saying that it's not going to be a consistent trend going forward. So I wonder what he sees in the inflation possibly pick up in the next couple of months. How does the budget crisis also impact inflation and the broader economy in Germany?
Yeah. Well, let's deal with that particular point, right? So one of the things, for example, in Germany, you have this budget crisis, and some of the money that was going to go to, that was now subtracted basically from the German government, was stuff that's going to go into energy subsidies, right? So you could see a bounce back in terms of energy prices. That's what Deutsche Bank is expecting in December. But more broadly, in terms of what it means for the economy, Deutsche Bank says that basically since the court ruling, they expect that it changed their whole view on what German growth would be the next year. They originally saw growth next year. Now they see contraction, and they say it could shave up to 1 percentage point off of German GDP, perhaps more. And again, they're still working through a lot of it. We just spoke to somebody on the budgetary committee here in Germany, one of the lawmakers, about that. And some of the highlights from the interview there, the question was, will the budget get done by year end? He does not know for sure, but he hopes so. Will there be tax increases to make up for the shortfall? He says no. And critically, will they extend the debt brake? Will they suspend it into 2024? He says it's not possible now because of this court ruling. But the main question, and this is what I asked him, will the coalition government survive this crisis? Here's what he had to say.
Yes, if you ask me, yes, you have to compromise, and you have to be honest and say, hey, folks, it's not going as we plan. We have to change plans, and we're willing to compromise. The other thing, like, oh, doesn't work, people don't like us, make new elections, and maybe then they like us. I don't think that is democracy.
And so while things are looking a little bit better on inflation, the budget crisis is really going to hit growth. And there's a lot of question marks still to be seen in terms of this German economy and what the impact of this budget crisis will be.
Ollie, thanks so much. Oliver Crook there with the very latest from Berlin. Now, the narrative of a Fed pause, of course, gaining further traction with dovish comments from Fed officials driving the dollar and Treasury yields lower. Now, the Fed Governor Chris Waller also says we're in a good spot for rates.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
Well, joining us for more on the markets, Sofia Ortega-Costa from Bloomberg's Markets Today team. Sofia, as always, thank you so much for joining us. So much focus once again on cuts. Bill Ackman, I was quite surprised, now expecting a cut even sooner than the markets, and then central banks still pushing back against that.
So central banks can push all they want, but the market is very much focused on anything that will kind of reinforce this narrative that interest rate cuts are coming. So what was important, and we just played that sound from Governor Christopher Waller, is that he is actually one of the Fed's most hawkish officials. So even if he is comfortable with where interest rates are right now and thinks that will actually bring U.S. inflation down to the 2% target, then it suggests a consensus among Fed policymakers who voted actually unanimously, very different to what we have here in the UK. There was a unanimous vote for a Fed pause. The fact that Bill Ackman is saying that actually the Fed will cut in the first quarter, that sounds a bit too soon, Francine. I mean, if the Fed pauses now, that pause hasn't lasted very long, and although talk around higher for longer, if we do get a cut in the first quarter, that's not very long. So, I mean, it's obviously an outlier bet because the market is pricing in a June cut. Bill Ackman, we know he covered his short Treasury trade a few months ago, so he could just be talking his own book as well.
I mean, I guess the question is, at what point do we see it impact earnings? And when we see impact earnings, if it's quite violent, then what does the Fed do in reaction to that? So, like, how soon could that come?
Yeah, exactly. And we don't know when that lag is, right? Because even though the interest rates have risen quite significantly across the world, that increase has been so fast that we don't know when that will actually feed through to earnings. We've seen that in the credit markets. We've seen some companies warn of a tougher outlook, especially for consumer-facing companies. The luxury market, that's kind of the first domino to fall. So whether we see that first impact, analysts are still forecasting profit growth in the U.S. and even in Europe next year. So there is still a little bit of room for positivity. What tends to happen, Francine, is that those estimates get cut at the beginning of the year. So let's see how fast those cuts will be. But so far, I think Citigroup is predicting as much as 10% growth for the S&P 500 companies. So still a positive story there. Let's see if stock prices follow that, though.
Yeah, and what I'm always surprised about is that we seem to, or the market seems to think that actually when inflation is down at critical level, it will continue going down. Whereas, again, when you speak to central bankers, they're worried that it's really tough to get to 2%, but also we could see a bounce back, and that could come at the end of the year.
And whether that 2% target is actually still the target, right? That's one debate also, that BOE Governor Andrew Bailey has alluded to, that the 2% target might not be reached next year. I do think the fact that central bankers are now driving down Treasury yields, bond yields, because it's not just treasuries, right? We're seeing a reaction across the world. That might actually take kind of the impact of higher interest rates and kind of undo some of that hard work against inflation. So there does need to be a balancing act when it comes to talking down the need for interest rate hikes and seeing the impact in the market there, Francine.
Sophia, thank you so much for all of the updates. Sophia Ortega-Costo there from our Markets Live team. Now, coming up, our exclusive interview with Jeffrey Pyatt, the U.S. Assistant Secretary of State for Energy Resources. That's coming up shortly, and this is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, tensions between Washington and Beijing are really putting a spotlight on reshoring, with U.S. manufacturers pivoting away from China to better secure their supply chains. A key focus, of course, is on the arenas of raw materials, including critical minerals and the energy sector. Well, I'm delighted joining me here in the studio for an exclusive conversation is the U.S. Assistant Secretary of State for Energy Resources. He's Jeffrey Pyatt. Thank you so much. You were also former ambassador, so thank you for we have a lot to talk about in this very complex space. First of all, Assistant Secretary, when you look at the U.S., should they actually consider subsidizing some of the domestic critical material projects like processing, but also refining or mining? That would give a competitive advantage.
So two aspects to this. One, it's very clear that we're not going to meet our climate targets unless we can deliver these critical minerals that are so important to the clean tech supply chain at a much greater than market-paced volume. So we need more cobalt, more lithium, more copper, more nickel, more zinc. A lot of that is happening and is going to happen because of the Inflation Reduction Act and the incentives that are provided there, but also our Bipartisan Infrastructure Act in the United States and all of the work that's being done by Department of Energy, by Department of Defense, to help both build the energy security aspect of our critical mineral resource, but also, as you say, to develop the volumes that we're going to require. We can't do this alone, which is why I'm here in London today.
But China has massive subsidies, right, for their industries in critical minerals. Is what you just laid out enough to counter some of that? That makes it easier for them to extract them.
So China's dominance of the market is a function in the first instance of their first mover advantage, the fact that they spent a decade acquiring these resources. We're trying to make a better offer. Based on market principles, driven by the private sector, driven by the high ESGs that are so important to my government, but also to our European partners, our partners in Asia. So it's less about subsidizing than it is about building a structure in which governments and countries are able to say, China's not the only off-taker here.
And that's a lot of what we're doing. It's what I've been doing this week in London. Had a terrific conversation yesterday, for instance, with the Nigerian mining minister, who was very, very keen on how do I get more Western companies into my country.
And is that concrete action? I mean, are we going to see a result in the next couple of years? Because there's always a timeline problem.
So you're already seeing some of that action. In the United States, it's being stimulated by the Inflation Reduction Act and the incentives that the Inflation Reduction Act creates for U.S. or FTA partner supplies of these critical minerals. We're negotiating an agreement with the UK right now and with the European Union that would provide those same FTA-level accesses to the U.S. market. But again, this is about building international partnerships. We can't succeed in meeting the climate crisis alone. The United States is 12% of global CO2. We have to bring along the rest of the international community.
I also wanted to ask you about the oil price cap in Russia. Is it working?
It is. It's working. We're trying to do two things at once here. We're trying to reduce the resources that Putin uses to pursue this terrible war against the people of Ukraine. But we're also trying to maintain stability in a global energy market that's been profoundly destabilized by Russia's actions. We're going to continue to work to tighten the noose on Russia's energy revenues. We've done that through our sanctions action against production. We've also done it with sanctions action against ship owners who are found to be circumventing the rules that the price cap coalition set up.
So when you look at the price of oil, it's about $75 a barrel. Is this a good time to actually buy some of that to put in these strategic petroleum reserves?
So the administration is moving ahead on rebuilding its SPR. But again, that's a domestic function, which I'm not involved with. And the key issue here is how do we reduce the revenues that Russia has available to it?
But it's important. Are we going in the right direction? Because there are many questions actually on, what's happened with Russia is that the sanctions have not worked to the full extent that a lot of people thought they would.
So I think it has in two senses. First of all, Russia's revenues are down. You just look at this October compared to last October. But also significantly what the future portends. You've had the withdrawal of major international oil companies from the Russian market. The technology services providers like Baker and SBJ have reduced their exposure. Crucially, the International Energy Agency assesses that by 2030, Russia's oil and gas revenue will be down by 50%, which is an enormous price that Putin is paying for this unnecessary war of aggression that he's unleashed.
When you look at the energy complex for the U.S., I know the strategic petroleum reserves are around 45% lower, I think, under President Biden. What's the optimum? Do you have an optimum amount of how you would replenish them, or is something that you focus on other things?
I mean, I focus on the international aspect of this. I mean, the clear picture is the United States is energy secure. Yeah. We have become the world's largest gas exporter, for instance. But we're committed to using that resource in a way that benefits global markets, in a way that's predictable, reliable, and reduces volatility.
Do you worry, for example, about the Panama Canal because of some of the droughts? I mean, we've seen ship stock, and this is a massive deal, actually.
I think it's, the most important aspect of that is what it tells us about the climate crisis and how important it is that we meet our energy transition goals. All of these extreme weather events, whether it's the drought that is reducing the carrying capacity of the Panama Canal, or what you're seeing happening across the global south in terms of extreme weather, the disruption of food supplies. All of this is a reminder. It's the globe screaming at us to say we have to move as fast as we can to drive this energy transition.
Are you confident that something concretely will be achieved at COP28?
So I'm confident that COP will provide an opportunity both to identify the opportunities that this energy transition is providing and to build the broad international coalition. It's very important that COP this year is being held in an oil-producing country because our energy companies, and that's true in the United States as much as it's true in the Gulf, they have to be part of the solution. Yeah. We need these companies to be working with us on decarbonization, on controlling of fugitive emissions, and of driving down the carbon intensity of the energy that they produce, even while we're continuing to invest in the wind and the solar, geothermal, nuclear, the renewable sources that are going to be the backbone of our future economy.
At the same time, the U.S. is still the largest exporter of LNG. So how do you square the two? So,
again, look at what the Biden administration is doing in terms of trying to reduce the carbon intensity of the energy that we produce. The U.S., like the U.K., we've seen a rapid phase out of coal, which produces immediate climate benefits. Much of that has been replaced by gas over the short term. Domestically, the Biden administration is working to reduce the carbon intensity of that gas that we're producing and supplying to global markets. We also support the measures that are being taken here in the European Union, in Japan, in Korea, to drive the accounting of that carbon intensity. I think you'll see some announcements at COP next week regarding initiatives, the Carbon Management Challenge, as we're calling it, in which we're seeking to enlist the energy companies, the fossil energy companies, to drive down their own carbon footprints.
And if we are going to get this done, you need the U.S. working with China. Were you heartened by the fact that President Biden met with President Xi? Does that make a meaningful difference to these talks?
It certainly does, as does the agreement that was reached between our climate envoy, Secretary of State Kerry, and his Chinese counterpart at Sunnylands. You'll have the U.S. and China working some events together at COP28, specifically in this methane abatement space, for instance. But China, over the long term, is a challenge on these issues of critical minerals, and our fundamental orientation is how do we de-risk our exposure to China on these critical aspects of the energy transition, whether it's solar cells, wind turbines, battery minerals.
Assistant Secretary, thank you so much for joining us today. That is Jeffrey Pyatt, the U.S. Assistant Secretary of State for Energy Resources. Coming up, Spain's Ferrovial is selling down its 25% stake in London's Heathrow Airport, with some going to Saudi Arabia. We'll look at whether the deal will successfully take off. That's next, and this is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Saudi Arabia's public fund, or public investment fund, PIF, is to buy 10% stake in London Heathrow Airport. Now, part of our shareholder reshuffle, the deal comes from a 25% holding being sold down by the Spanish firm Ferrovial. Now, for more, I'm joined by Benedict Camel. He's our Bloomberg expert in global aviation. He's in charge of business here at Bloomberg. So, Benny, thank you for joining us. I mean, what does that tell us about Saudi Arabia's, I guess, interest in UK assets?
So Heathrow is obviously an important asset in the UK. It's well known around the world. It's one of the biggest airports in Europe. And for Saudi Arabia, this was probably a good opportunity to buy into an asset. There was a willing seller in Ferrovial. They had signaled that they wanted to get out of this. Ferrovial bought the stake, or bought the asset in 2006. So we're talking about almost 20 years of ownership. They wanted out, Saudi wanted in, so this was sort of buyer and seller coming together.
And so is it still London's, I mean, it's London's biggest airport. Is there anything else for sale? Like, what does it tell us about, you know, things that could come up on the block?
Right now, it doesn't seem like there's anything immediate on sale, but airport assets have always been interesting for buyers from the Middle East. Qatar is the other big owner of Heathrow Airport. Qatar also owns a stake in IAG, the parent of British Airways. So there is interest in these sort of halo assets out there. Qatar also owns a stake in...
Why?
Well, the UK has historically been fairly open to let in foreign owners. Some other countries might be a little bit more wary of letting in Saudi, Qatari assets. And the UK has also always had a slightly more laissez-faire sort of attitude towards this. So it's a 10% stake at this point, so they get a foot in that door. And for Ferrovial was probably also the issue that they didn't really see any growth in this asset. So they thought, let's get out at a time that seems like a good moment. And for Saudi Arabia, this might be the beginning of doing more. They've owned football clubs here in the UK, so this is just more of a UK play for them.
Benny, thanks so much. Benedict Camel there with the very latest on Heathrow. Now, coming up, global bonds soaring at the fastest pace since the 2008 financial crisis. But has the rally got further to go? We discuss that next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Global bonds march towards their best month since the financial crisis as expectations grow that the Fed is done with policy tightening. German CPI expected to fall after a key region showed prices cooling further in November. And Charlie Munger, who helped Warren Buffett transform Berkshire Hathaway into an empire, has died aged 99. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, veteran investor Bill Ackman says he sees the Fed cutting rates as soon as the first quarter of next year. The founder and chief executive of Pershing Square Capital Capital Management spoke to David Rubenstein, who asked him whether the U.S. can actually avoid a recession.
I think it's really hard to predict. I do think the economy is weakening. We're seeing, evidence of that in some of our companies. You're seeing. And I have some concerns. There's been a huge subsidy in terms of low interest rates, and most companies fix their rates or their debt at very low rates, and certainly real estate investors did the same, and that works until it doesn't work. And so I think what's going to be interesting is to see what happens when people have to reprice their debt, and I think that can have sort of a cliff-like effect, and you're certainly seeing that in real estate.
Now, the markets are assuming, and the markets are not always right, but the markets are assuming that there's going to be a Fed discount cut sometime next year. And as we talk now, just about the end of November, it's not clear what the Fed will do, but some people say that the Fed, if they were to cut interest rates next year, would help the Democrats and therefore be seen as very political. On the other hand, some people say the Fed can't wait till after the election because the economy might need a stimulus. So you have a view on what the Fed's likely to do?
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle fives, and inflation is trending below 3%, or that's a very high real rate of interest, and I think that is having a sort of retarding effect on the economy. And then, of course, again, many businesses and certainly many individuals have the benefit of fixed rate debt. And that fixed rate debt, certainly for companies and for commercial real estate, starts to roll off. So I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
By its own admission, the Fed probably missed inflation initially. They said it was transitory, but they've played catch up and they've increased rates considerably since that time. Do you think the Fed made a mistake in not handling inflation differently in the beginning? And how do you think they've done since they started increasing interest rates?
They certainly made a mistake. I mean, I think that the Fed generally as an institution would admit that. I think that they caught up effectively, so you give them credit for acknowledging the mistake and being pretty aggressive. And then I think, you want to make sure that they're, Chairman Powell's desire not to have a legacy of causing or contributing to long-term inflation doesn't, cause them to make the opposite mistake, i.e. keep rates too high for too long. And I think the market expectation is, it's called middle of next year, July, something like this, for the beginnings of easing. I think the economy will likely demand an earlier move. And I don't think of the Fed as or at least this Fed, as a particularly political institution. I think they're really trying to do the right thing.
Well, you can watch that interview with Bill Ackman in full on the David Rubenstein Show, peer-to-peer conversations. The episode debuts right here on Bloomberg TV on December the 6th. That's next Wednesday. Now, global bonds soaring at the fastest pace since the 2008 financial crisis on a dovish shift in Fed expectations. A Bloomberg gauge of global sovereign and corporate debt has returned 4.9% in November so far. That's the biggest monthly gain since December 2008. Now, this comes as the Fed Governor Christopher Waller says the current level of policy looks well positioned to slow the economy and bring down inflation. Well, joining us now from Dubai is our markets and FX guru, actually our guru when it comes to all global bonds, Ven Ram from Bloomberg's Markets Live team. So, Ven, first of all, I really, really want to hear your thoughts on Treasury. Are we going to see this Treasury rally more in the coming days?
Morning, Francine. Thank you for the kind words. You're too kind. Well, I do think that there is a short-term basis for a short-term tactical rally from what Waller said, because not only was he dovish, but he expressly said that during the question and answer session, which I think many in the media have missed, is the fact that he's talking about rate cuts. If we see successive rounds of disinflation, we've already seen a fairly entrenched disinflationary process, and if it continues, he's basically saying that there will be rate cuts. And if that is going to be the guiding factor for the markets, as it is now, I think that rates have plenty of room to rally, particularly the long end, because real rates are high.
So do you think the market is just pricing, that the pricing for a Fed rate cut is right, or is it just wrong?
No, I think the markets are kind of pricing a first rate cut in May, and I think that that's pretty much in the ballpark. I think a lot of it will depend on the further disinflationary process. We are expecting core inflation to come in at below 3.7%. 3.7% is the level that the Fed indicated we will get to by the end of this year. So if we get 3.5% this week, that will tell the Fed that, look, the disinflationary momentum continues. But of course, 3.5% is not 2%, and there is plenty that will drive the narrative between 3.5% and 2%. And we just need to wait for the data points and the economy to see how the economy fares between now and spring of 2024.
So, Van, what are you expecting? Again, it's not linear. A lot of central banks are really pushing back against this idea of interest rate cuts. But I don't know how difficult is it at this point in time to know what inflation does and therefore what the reaction function will be?
I think the reaction function will be a lot different for the major central banks at the very least. We have got the Bank of England pretty frantically pushing back on the notion of the markets that, look, a rate cut is around the corner. I think the markets are pricing a rate cut from the BOE in August, and the BOE has been pretty much all of this week been drumming on the message that, look, a rate cut is not on the cards because services inflation and core inflation are simply too high. It's not the same narrative in the US. In the Eurozone, it's a bit more nuanced, where I think that the ECB has a bit more room to be a loosening policy later on next year. So the reaction functions are going to be pretty starkly different, Francine.
Thank you so much, as always, for all of your insight, Van Ram, from our MLive team in Dubai. And you can also follow everything, of course, on the Bloomberg terminal. Now, Bloomberg's Joe Easton is here with a check on your stocks on the move. Hi, Joe.
Morning, Fran. So there's more disappointment for Philips today, which is slumping over in Amsterdam after the US FDA warned last night that some users of the DreamStation 2 sleep apnea device have been warning that it is overheating at times. Now, this product was actually issued as part of a recall of the original DreamStation 1, which was emitting a foam which was said to be hazardous, and Philips has already set aside around €1 billion in order to fix that problem. That stock now headed for its worst day in around a year and is down more than 40% since the company announced the issues in that product in 2022. Meanwhile, we're also over in Spain looking at Ferrovial as the Saudi wealth fund buys a stake in London's Heathrow Airport, the UK's busiest airport. Now, this is priced at around £2.4 billion. Some of the stake is also going to private equity, but the sale to the Saudis is potentially controversial. But it is a good price for Ferrovial, which has had a stake in Heathrow Airport since 2006. It is around 70% higher than analysts at Morgan Stanley were expecting them to sell that for. And as such, we're seeing Ferrovial jumping around 2.5%, one of the best performers in Madrid today. Finally, a stock that's not doing very well at all is Halfords. This one dropping as much as 23% today. The UK retailer of bikes and also car products warning that people in Britain are cutting back on big ticket items, so big slowdown in sales following the surge that we saw during the pandemic, people cutting back due to the cost of living crisis. The car maintenance business does remain pretty strong, given that's pretty recession-proof. People still need to maintain their cars during a recession, but it is the big ticket bike items hitting that stock. Liberum cutting it to sell, and that's the biggest decline that we've got in the UK today.
Thank you so much. Our Joe Easton there with the stocks on the move. Now, also making news, Amazon rolling out a workplace chatbot called Amazon Q. this could be good. Now, it's designed to help corporate customers search for information, write code, and review business metrics. Amazon Web Services, the company's cloud computing division, is adding generative AI into more products to reclaim ground in a field led by its main rivals. Microsoft and Google have announced similar moves. I was hoping for something to do with expenses, the fact that they would file them for you. Bloomberg understands that Miriam Adelson, the widow of casino magnate Sheldon Adelson, is buying a majority stake in the Dallas Mavericks NBA franchise. Now, in a regulatory filing, the Adelson family said it already has a binding purchase agreement. The Mavericks franchise is currently owned by Mark Cuban. Now, the Adelsons are selling $2 billion in stock in Las Vegas Sands to fund the acquisition. And Morgan Stanley is fighting to overturn a French court ruling after it was ordered to pay 1.4 million euros to bonuses to a former banker who quit. While former employee Bernard Moureau's lawyer argued his client bonus should be paid with the bank, arguing they were only payable if he'd stayed on. Now, the case could affect attempts by investment banks trying to prevent their best performers leaving their jobs. Coming up, ahead of the COP28, we take a look at the ESG Market Navigator Survey results from Bloomberg Intelligence. Through the lens of ESG, we'll talk climate finance, geopolitical risks, and more. That's next, and this is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
Number one, this is what's called a stock take year. Governments around the world will show up and show the progress they've made in terms of getting closer to net zero by 2050. Number two, climate finance. How can we get more money from the richer part of the world to invest in green technology? Number three, so this year's COP is in Dubai. There's a lot of controversy around the fact that it's run by an oil and gas superpower, but they are also very conscious of that, and they're making a big push to get oil and gas companies to commit more to cutting their methane emissions. That would be a big deal. And the fourth point we're looking for is going to be getting countries to commit to tripling their investments in renewables by 2030. So those are the four main points that we're going to be looking at COP this year.
That is, of course, John Farrar, our Senior Executive Editor for Energy, Climate and Equality, with a look at what to watch as COP28 begins tomorrow. Now, ahead of this year's COP, Bloomberg Intelligence has also reached out to over 200 C-suite executives and investors to take really the pulse of ESG market sentiment. Now, we're now joined, I'm delighted to say, by the report's author, Adeline Diab, who's also Chief ESG Strategist at Bloomberg Intelligence. So, Adeline, congratulations to you and your team to actually really putting this amazing survey together. The question is ESG dead or not? How did people answer?
So ESG is definitely not dead. With the recent backlash dominating the news, we wanted to cut through the noise and really ask markets their perception and priorities about ESG. So this is why we conducted this global survey, Bloomberg Intelligence ESG Market Navigator. And this reveals that basically ESG has become a backbone to both financial markets and corporate strategy. 85% of investors see ESG leading to better returns, more resilient portfolios, and enhanced fundamental analysis. 84% of corporates see ESG helping to articulate stronger corporate strategy and actually take into account in their M&A plans.
Is there a concern, though, I guess, in this geopolitical context where it's extremely fluid, it's extremely concerning? There's two wars that actually it's taking a back step compared to some of geopolitical issues.
So, yeah, geopolitical and macro risks have been two risks ranked by investors and corporates as reasons that may deter them from their ESG plans. However, the long-term agenda remains intact. 85% of both investors and corporates plan to boost their ESG investments and assets under management, their capex and spending. We expect 3 times more investors to increase their ESG research budget by 20%. Both groups really are pursuing ESG in a bid to improve profit, brand value, and competitiveness.
So, Adeline, at the same time, is it now just much more acceptable to invest in fossil fuel?
So that's a good question. And 60% actually of investors recognize that it has become more acceptable to invest in fossil fuels due to the energy risk, security risks that have emerged over the past 18 months. But the survey also reveals that energy transition is top of mind. 70% of executives really see energy transition as a competitive advantage that also gives them access to cheaper financing, access to capital that is key, and all the scrutiny that is associated to that is worth the commitment. And actually, 81% of executives fear losing market value and activism if they fail on articulating a strong energy transition plan.
That's really interesting. What are you expecting from COP? So you'll be traveling to COP. I mean, there's expectations are not actually very high, but there's also a lot of stuff that needs to be done to lay the groundwork for them for the future.
Yeah, I guess what to watch for really. So I would say climate has went from a fringe concern to becoming mainstream, to becoming mandatory over the past decade. But now it's really about accountability, and that's what I would watch for this year. And I would make 2 points. One is energy transition plans, which you just touched on. According to our survey, only 57% of executives believe that they will reach their net zero targets, and 67% believe their peers will not reach their net zero targets. So it's very important for corporates to focus on articulating those transition plans. But the second point is that to deliver this accountability, the investor-corporate dialogue will be key. Yeah. And according to our survey, 60% of investors are asking questions and holding companies to account, and 40% of executives admit facing ESG and climate questions on half of their investors' calls. So this is strong reasons to be optimistic.
Adeline, thank you so much for everything and a wonderful survey, and we'll catch you, of course, in COP to see what the latest survey will tell us. Now, Adeline Diab from Bloomberg Intelligence. Now, also stay with us, so we'll bring you all of our top lines from this year's United Nations Climate Change Conference in Dubai. COP28 begins on Thursday night. Finance Day is actually on Friday. We'll preview discussions on net zero progress, climate finance, and much more. Coming up, remembering Charles Munger, Warren Buffett's longtime right-hand man, who's died at the age of 99.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Berkshire Hathaway has announced the death of longtime Vice Chairman Charlie Munger. He was 99 years old. Now, Warren Buffett honored his right-hand man, saying his inspiration, wisdom, and participation helped shape Berkshire Hathaway. Now, here's a look back on his life and legacy.
Charles Munger served as alter ego, sidekick, and foil to Warren Buffett for almost 60 years as they transformed Berkshire Hathaway from a failing textile maker into an empire. A lawyer by training, Munger helped Buffett craft a philosophy of investing in companies for the long term. In 1962, the two men began investing in Berkshire Hathaway, a Massachusetts company that made men's suit linings. Even after the mills closed, Berkshire stuck around as the corporate vehicle for a growing conglomerate of companies. Focusing on businesses with strong brands and pricing power, Munger nudged Buffett into acquiring California confectioner See's Candies in 1972. The success of that deal inspired Berkshire's $1 billion investment in Coca-Cola stock 15 years later. At the company's annual meetings at Omaha, Nebraska, where he and Buffett had both grown up, Munger was known for his roles as straight man and scold of corporate excesses. The acerbic Munger so often curbed Buffett's enthusiasm that Buffett jokingly referred to him as the abominable no man. Still, for many years, Munger was more bullish than Buffett when it came to investing in China. His purchases of stock in Chinese automaker BYD resulted in Berkshire becoming that company's largest shareholder. And even as his partner became a worldwide celebrity, known far and wide as the Oracle of Omaha, Munger believed Berkshire's success would outlast Buffett's star power.
In my opinion, Berkshire will flourish after Warren's gone. I don't think anybody is essential given the momentum we now have in place.
He didn't overstate his own importance either, sharing his vice chairman title at Berkshire in 2018 with two next-generation senior executives, Greg Abel and Ajit Jain, and affirming the company's commitment to a succession plan.
Well, joining us now for more on Munger's life and legacy, Bloomberg's Charlie Weil. So, Charlie, thank you for joining us. I mean, he was an extraordinary man, actually, because of what he's achieved. But for people that are a little bit unfamiliar with him, what was so special about Charlie Munger that really made him Warren Buffett's right-hand man?
Yeah, well, they had a partnership that really went back so many years. They met sort of by chance in 1959 in Omaha, Nebraska. And that was actually the hometown of both of these men. Munger was born in 1924. He actually worked worked Saturdays at the grocery store that belonged to Warren Buffett's grandfather. And from the moment they met, they really hit it off. They had phone conversations almost daily for hours where they talked about investment strategies. And I think what's really striking is that, we hear so much about Warren Buffett. We know that he does like attention, and we know that Charlie Munger sort of pulled him back. He had a very different perspective, but also educated him in a lot of the ways of investing and kind of shaped his strategy.
Yeah, but he has a lot of groupies, or there's still a lot of quotes from him, like all over the internet, on Instagram. So what were his principles that he invested on?
Well, he was known for quoting the likes of Confucius, of Mark Twain, but even some of his very own quotes, really almost rank up there. So he said one thing to Warren Buffett early on in their career, and it was, stop looking for fair companies at wonderful prices. Look at wonderful companies with fair prices. And that kind of changed Buffett's trajectory going forward. So he had invested in companies that he himself called cigar butts, which were effectively companies sort of on their last puff. And basically the turn here was to look at firms that had pricing power, that had, name recognition. Started, really in earnest in 1972 with See's Candies, a chocolate company from California. But they took a lot of those learnings to firms like Coca-Cola and Apple, which really are just, some of the best investments that they made.
It's just amazing. Thank you so much, Charlie Wells there, with, of course, all of the latest remembering the man that was Charlie Munger. Up next, we have Bloomberg Brief, Danny Berger in London, Manus Cranny in New York. We'll have a full roundup of all of our top news stories. We also look at the market with that Bill Ackman interview that David Rubenstein did on him expecting Fed cuts even earlier than the markets. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood in my mind how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
on the next episode of the Business Week Show. Imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup.
This is a 3
as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
A very good morning from our world headquarters in New York. I'm Menace Cranny.
And I'm Danny Berger, on assignment in Paris. Welcome to Bloomberg Brief. Let's set your agenda.
Global bonds march towards the best month since 2008 as the Fed's most hawkish officials hint an end to the hiking cycle is near.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
And on Capitol Hill, congressional negotiations are preparing to drop the China investment curbs from the annual defense policy bill. And the legendary investor Charlie Munger, who helped Buffett build Berkshire Hathaway into an empire, has died at the age of 99. Let's get straight to Paris. She's on tour, clocking up the air miles for Bloomberg Brief. You get all the sort of, beautiful destinations for Christmas. Danny, good morning.
Good morning, Manus. That's right. I'm in Paris trying my best not to spend all my money at Galeries Lafayette or eating all the pastries, but I'm here for more important stuff than that. Later today, I'm going to be speaking with the chairman of Deutsche Bank, Alexander Wynand. Manus, it's been a strange week in banks and a strange year in banks. I mean, you and I have talked about this. Thousands of cuts, whether it be clients or jobs at Barclays. Restructuring is abound. Deutsche Bank has been restructuring for some years. So I'm interested to hear what the chair thinks of all of it.
Well, I mean, you just look at the context of what's gone on. You've had job cuts after job cuts. Nomura, I think you and I focused in on this. There you go. There's your chairman that you're going to be speaking to later on today. What happens next? Deutsche Bank has had its own cycle of major changes under von Moltke and, of course, the CEO there. You're looking at UBS Credit Suisse integration. Is the worst of that done? Nomura, another $100 million worth of cuts to come through. And, of course, Prince Walid double dipping back into Citi this morning. A lovely headline. We'll talk more about that later on.
Yeah, we certainly will. And look, he's been on the job for just over a year. Before he was at Aegon, an insurance firm. He had to live through the financial crisis. Does he see this as another moment akin of financial crisis levels of restructuring? But in the meantime, Manus, we have some new estimates from the OECD economists on what exactly is going to happen next year.
We have, and those breaking headlines, I know you've got them there. You're going to be in that building a little bit later on. But the OECD world GDP growth, 2.9% in 2023, Danny, from 2.7% going to 2.7%, dropping to 2.7% in 2024, and 3% in 2025.
Yeah. That's a long time till we get back to 3%. They also said that the risks to the near-term global outlook are tilted to the downside, and they expect a soft landing, but this is far from certain, Manus.
It is. Well, I'm going to take you back to 2008 and have a look at the bond market. Please Beyonce was number one. She was singing about a child. This is the global bond market, about a boy. This is the global bond market. Just think, we were in the depths of a global financial crisis. Rates had been cut to 0%. And that is the last time you saw this kind of magnificent movement in the bond market. It has been an exceptional global delivery there. Let's look across the markets. 10-year yields drop ever so slightly this morning and have a look at this exceptional bond rally, because the Bloomberg Aggregate Global Index, as I say, 4.9% for the month of November. Now, the alpha to this movement was the Fed speak from Wallers. Something appears to be giving. If inflation continues to cool several months more, we could see perhaps in 3, 5, 6 months, we could talk about cuts. Now, what you've got here is a bond market that absolutely collapsed yesterday in the 2-year paper, also diving lower by 15 basis points in the day session. That goes lower again this morning. The JP Morgan survey has the specs being the most bullish on this bond market since 1991. That's where the fast money is. The dollar is up off its knees. You've got various views out there. You know, rates rolled down, and that caused the dollar to drop for the 5th day in a row. We've just managed to eke out some green there. Bill Ackman's talking about rate cuts in the first quarter if there's a hard landing, and oil markets are grasping on to the talks. Will they find this elusive compromise between Angola, Nigeria, and the rest of the members of OPEC? Quota cuts are what is needed, but the bullish bets in this market have dropped to the lowest since July.
The fuel for the bond market is fuel for this equity market, Manus. We are higher for a second day in the U.S. future session, higher by not loads, but still it is interesting to see as bets for potential recession shape up. Stocks are able to hold up. Here's another interesting one. We also have Goldman saying that this sharp drop in volatility, it's an opportunity for hedging. So sure, the VIX is near a 2020 low when it comes to just how worried and volatile this market will be. So jump in there, say Goldman. Meanwhile, European banks unable to put in any gains. Maybe that has to do with bond yields coming down, but you think maybe they could with this Bloomberg report that the ECB policy members there, the watchdog arm to be specific, want to make it easier for banks to give out dividends once the top of the policy committee there for watching over banks drops out. Meanwhile, Hang Seng, tough day for Hong Kong stocks, on course for its lowest close in a year. Tech firms, Manus, dragging it down after warning from the food delivery giant Meituan.
Okay, well, that's the state of play. As you say, the movement in these bond markets is giving succor and life to that equity market rally. Let's talk about the Treasury market. As I say, headed for its best month since 2019 as the markets bet on rate cuts for next year. Pershing Square's Bill Ackman warns against a delay in the pivot.
But I think there's a risk of a hard landing if the Fed doesn't start cutting rates, pretty soon. So, I think the market expects sometime middle of next year. I think it's more likely probably as early as Q1.
Well, joining us now for more on global inflation is Sandra Horsfield, economist over at Investec. So a fairly damning view there from Ackman. Hard landing if they don't cut rates in the first quarter. So that gives us a 4-month window. Do you expect such a material slowdown in the U.S. economy that would warrant pulling those rate cuts forward into Q1?
At this point, we don't quite see this. We still think that there is enough underlying momentum, and from the fact that we do now have lower inflation, we have more purchasing power that's being handed to consumers as well. So perhaps not all doom and gloom. If you look at the global manufacturing cycle, again, some slightly more positive news there, perhaps some stabilization, some bottoming out. So altogether, we think we'll avoid the hard landing, but still, rate cuts will have to happen. Perhaps we think the second quarter is the most likely still.
Second quarter, okay, still on their way, Sandra, but you also point out that the rally in treasuries, the best month, as Manus pointed out, since 2008, has undone tightening, and that will worry the Fed. What then do you make of a hawkish member like Waller, instead of pushing back on that, seemingly endorsing it, saying that they're in a good spot to get to 2%?
I think one thing we have to bear in mind specifically about the US economy is that we're not just seeing solid growth, but we have actually seen a decent run of labor productivity gains. So that's quite different to what we're seeing, say, in the UK and so forth, where labor productivity has been lagging. So the US can afford more wage inflation without the long-term inflationary pressures this generates relative to other places. So that perhaps underlines some of this confidence that indeed we can get inflation down sustainably in the US more easily than elsewhere. And that's a key factor to bear in mind in this picture.
If you look at the landscape, though, Sandra, the market is baying for cuts, isn't it? I mean, the momentum in these bond markets, 2-3 standard deviation moves in Japanese bonds this morning. Australia is catching up. We are lit up. Inflation, I'm not saying it's under control, but the trajectory of inflation in the United States, the 5-year forwards, along with the inflation data in Germany this morning, do you think it adds up to 100 basis points of cuts in the US and 100 basis points of cuts in Europe? Is that a base case for these markets? Because these bond markets are now front-running that assumption.
I think inflation is all about certain drivers, but also a lot about inflation expectations and what's built into expectations. And central banks have got an important job in managing those expectations. So going too far, too fast with rate cuts does risk perhaps prolonging some of those pressures that we have seen elsewhere. So we think going quite 100 basis points worth of cuts, maybe that's overdoing it. In our view, we have 75 over the course of next year. Much will really depend on just how much of the core inflationary momentum is maintained. Yes, we have had a big step down in inflation. A lot of that has, however, affected energy prices directly and indirectly. So those have now bottomed out. So where do we go from here? It will be a little bit harder to get this disinflationary momentum to remain than it has been until now to get inflation down from the very high rates.
Sandra, 2024 is also an election year for the U.S., but also more than half of the world's population. But does that make a difference to central bank policy? Does Pennsylvania Avenue influence the Eccles building, whether indirectly or not?
I think it's very difficult for monetary policymakers to directly take into account what could happen in an election where the outcome isn't certain, and certainly they don't want to be drawn into a political debate and be seen to take sides. Monetary policy does have to rise above the frame in this case, so perhaps not. Certainly volatility is something that's not welcome to any central bank. Volatility isn't good as far as investment prospects are concerned, so indirectly there's an effect. Very directly, though, perhaps not so much, until, of course, we know the outcome of the elections and what policies will actually be implemented.
We underestimated inflation. We underestimated the trajectory of inflation, the durability of inflation. We underestimated the consumer. We underestimated the durability. I could go on. A lot of missteps in assumptions. So are we perhaps underassuming the drawdown in savings and the running out of fiscal largesse from the COVID era? Could that snap a lot more quickly, perhaps, than we all think? Because there are cracks in the consumer, and they are appearing.
Yes, certainly you're right. There are signs that things are beginning to turn. Credit card data, for instance, are showing rising delinquencies in the US. So that does point to some softening in this consumer dynamic. We do start from a very strong base, though. And if we look at the labor market, yes, of course, we're not quite at this exceptional growth phase that we had beforehand, but still relatively robust. So how does this feature? When at the time when inflation is lower, wage growth does mean more real spending power. I think that's the real question going forward. So we're not that pessimistic for the time being. So perhaps recession will be avoided. But as many say, it is a fine line and there are no guarantees.
I'll tell you what, Sandra, it's hard to look at $9.8 billion spent on Black Friday online in the U.S. alone and be pessimistic about the consumer. They're still happily buying. Manis helped. What did you buy, Manis?
I told you, a suit and a TV. Got the TV last night. It's amazing.
Oh, of course.
OLED.
I'm sure that was a big proportion of the 9.8. Hey, Sandra, we'll let you go. Investec's Sandra Horsfield, thank you so much for joining us. All right, Manis, let's get to some of the other top stories that are trending on the terminal this morning. Saudi Arabia's public investment fund will buy a 10% stake in London Heathrow Airport as part of a shareholder reshuffle. The PIF is becoming a partial owner of one of Europe's busiest airports alongside the Qatar Investment Authority.
And Kingdom Holding, the investment company of Prince Al-Walid bin Talal, has raised its stake in Citigroup to 2.2% after buying $450 million stake from the Saudi billionaire. Al-Walid is one of the highest profile Saudi investors after taking stakes in companies such as Citigroup and Apple.
Apple, speaking of which, is reportedly preparing to wind down its credit card accord with Goldman Sachs. The Wall Street Journal cites sources saying Apple is proposing an exit within 12 to 15 months. That would end a partnership that was once seen as a major growth opportunity for the two companies.
Coming up, the loss of a legend. We look at the life of Charles Munger and how he helped build Berkshire Hathaway to an empire with Warren Buffett, right here on Bloomberg.
this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
You're watching Bloomberg Brief. I'm Danny Berger on assignment in Paris. Manus Cranny is in New York. Now, Berkshire Hathaway's longtime vice chairman, Charlie Munger, has died. He was 99 years old. Warren Buffett honored his right-hand man, saying his inspiration, wisdom, and participation helped shape his firm. Here's a look back on Munger's life and legacy.
Charles Munger served as alter ego, sidekick, and foil to Warren Buffett for almost 60 years as they transformed Berkshire Hathaway from a failing textile maker into an empire. A lawyer by training, Munger helped Buffett craft a philosophy of investing in companies for the long term. In 1962, the two men began investing in Berkshire Hathaway, a Massachusetts company that made men's suit linings. Even after the mills closed, Berkshire stuck around as the corporate vehicle for a growing conglomerate of companies. Focusing on businesses with strong brands and pricing power, Munger nudged Buffett into acquiring California confectioner See's Candies in 1972. The success of that deal inspired Berkshire's $1 billion investment in Coca-Cola stock 15 years later. At the company's annual meetings in Omaha, Nebraska, where he and Buffett had both grown up, Munger was known for his roles as straight man and scold of corporate excesses. The acerbic Munger so often curbed Buffett's enthusiasm that Buffett jokingly referred to him as the abominable no man. Still, for many years, Munger was more bullish than Buffett when it came to investing in China. His purchases of stock in Chinese automaker BYD resulted in Berkshire becoming that company's largest shareholder. And even as his partner became a worldwide celebrity, known far and wide as the Oracle of Omaha, Munger believed Berkshire's success would outlast Buffett's star power.
In my opinion, Berkshire will flourish after Warren's gone. I don't think anybody is essential given the momentum we now have in place.
He didn't overstate his own importance either, sharing his vice chairman title at Berkshire in 2018 with two next-generation senior executives, Greg Abel and Ajit Jain, and affirming the company's commitment to a succession plan.
Joining us now to talk about the legacy of Munger and what's forward for Berkshire Hathaway is Bloomberg's Charlie Wells. Charlie, Charles Munger was often talked about by Warren Buffett as someone who would challenge him. He wasn't a sycophant that, as Buffett, in Buffett's words, that a lot of other CEOs surrounded themselves with. What does it mean for the direction and what happens for Berkshire Hathaway next?
So Charles Munger loved architecture, and I think that is a hint of where this firm could potentially be headed. So he donated millions of dollars to architecture at universities across the United States. He also built Berkshire Hathaway literally brick by brick with Warren Buffett, and we do know that there is a succession plan in place, and I think investors certainly will hope there is, given the returns that they have had over the decades. So if you invested $1,000 in Berkshire Hathaway in 1964, today that investment would be worth $10 million. So we know that in 2018, Munger started to share the vice chair title. We know that Greg Abel has been named as the successor to Warren Buffett, but Munger leaves huge shoes to fill.
Well, he was certainly vocal in his, I suppose, commentary around remuneration, demented immoral compensation in the corporate world and the packages. Bitcoin was noxious poison. The question I have this morning is, what does it mean for markets? What does it mean for the investment world? I mean, this thesis of investment has done not just the shareholders, but these two incredibly well. Is there a repercussion for the investment world?
Well, Munger is credited with, helping to form that value investing thesis that was so successful for Berkshire, right? So, Warren Buffett talked about how he used to invest in, quote, cigar companies. So these were companies that were sort of on their last breath. Munger said, let's shift this around early on in the days of Berkshire. Let's start looking at companies that aren't just, wonderfully priced, but companies that actually are wonderful in and of themselves. And man, as you say, I think that this is a loss to the investment world. I mean, this is someone who was okay with conflict. So famously, Munger and Buffett never argued, but they certainly did disagree. Munger famously a Republican, Buffett famously a Democrat, but these were not executives who took to social media to say controversial things and then, silence people who dared to disagree with them. These were people who could have difficult conversations and reap the rewards.
Yeah, well, the world could maybe take heed from some of that level of discourse and discussion. It's called a conversation, Charlie, with one another. That is Charlie Wells on the life of Mr. Munger on Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
It's Bloomberg Brief. I'm Menace Granny in New York. Danny Berger on tour in Paris. This bond market is lit up. Danny, let's just check in. JGBs and the Australians, they're playing the catch-up. The Aussies are playing the catch-up game on the US Treasury market. You can see down 13 basis points in Australia. But it really is about the belief that this pivot, what will Powell say to either reinforce the propensity for rate cuts that the market is baying for, 100 basis points of cuts next year, which our guest, our first guest this morning, said is unlikely. They're going for 75. Danny, good morning. How's Paris?
Good morning, Manus. Hi from Paris, away from the bond market. I'm here in the office, and it's probably apropos then that Bloomberg Intelligence had a work from home study. Manus, how about this?
Go on.
More people are able to work from home in London than they are in Paris. 4% of Londoners aren't allowed any form of remote working compared to 20% of Parisians who aren't allowed work from home. Manus, can I tell you why you should work in the office here in Paris?
Go on.
Can I
I've been to that office, actually, and it's very, very beautiful, I've got to say.
No, it's really nice, but here's the best view. I think we have video of literally the best view in the entirety of the Paris office. I don't want to spoil it. I want to. Okay, yeah, it's the pantry. This is it, Manus. Look at it. Look at this beautiful spread. This is why you need to work.
Who left a croissant on the side of the plate? Who left that?
I don't know if that's a nibble because, Manus, I happen to have that very croissant with me right here.
Yeah.
I have it, and I'm ready to eat it once the show over. This is my post-show treat because I am in Paris and I deserve carbs.
I tell you what, that's a brave statement on this show. I'm the food police and you're just munching on beautiful Parisian croissants. I can tell you they're not like that here. We'll have more from Paris in just a moment. We'll talk about European rate strategy. There you go. Tie up a bow on the Parisian experience with Danny Berger.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Welcome back to Bloomberg Brief. I'm Menace Graney in New York.
And I'm Danny Berger in Paris. Here's what you need to know. Global bonds march towards their best month since 2008 as the Fed's most hawkish officials hint at an end to the hiking cycle.
I am increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%.
On Capitol Hill, congressional negotiators are prepared to drop China investment curbs from the annual defense policy bill. And legendary investor Charlie Munger, who helped Buffett build Berkshire into an empire, has died at the age of 99. Now, we've been looking back on Charles Munger's life, but let's take a pause on that and look forward to what this equity market is doing this morning, Manus, because it's another morning of gains. Future markets are indeed higher, about 1/3 of 1%. JP Morgan cautions that this rally is maybe going to be challenged in 2024, while Goldman Sachs says, hey, the VIX is extremely low. Load up on the market hedges. It is cheap and it makes sense considering all the unknowns. European banks finally pushing into the green, but just barely. A Bloomberg exclusive report that the ECB does want to lower the barrier for banks in Europe to be able to give back dividends to their shareholders once the current chair, the supervisory part of the ECB, steps down. Meanwhile, Hang Seng Man is having a difficult run of it, down 2%, on track for its lowest close in more than a year. Meituan, the food delivery giant, had some pretty poor earnings, so those shares moving lower, Manus.
Yeah, and we're also hearing notes from UBS as well. It's time to load up on your hedges. It's a cheap time to do it. And sometimes Mark Hayfley and the team at UBS say, look, it's a squandering of money perhaps to buy volatility, but those selling those put spreads or indeed buying calls could be the way forward. Now, when it comes to this bond market, it's a very interesting move. This was a collapse at the very short end yesterday, down by 15 basis points. You're seeing, again, a continuation lower in yields this morning at the short end of the curve. So we are pivoting from this bear steepening in the curve to a bull steepening. So you are seeing this momentum at the very short end of the curve. That's where the real alpha came in. Waller spoke. The title of his speech was "Something appears to be giving." It appears to him inflation is giving in 3, 5, 6 months. You could be talking about rate cuts, and that's what Bill Ackman is talking about, rate cuts potentially even in the first quarter and a hard landing if they don't cut rates. By the way, in terms of positioning, the JP Morgan survey is out. The specs are the most bullish on record going back to 1991. I think I got my first Bloomberg terminal in 1992. There you go. And I can remember who sold it to me. The dollar rolled down, basically on this roll down on rates. You're seeing a little bit. It's desperately trying to sort of claw something back. 5 days in a row, we got trashed on the downside. If you have a hard landing and bad growth next year, what happens to the dollar? We'll put that to our guest. Crude is clawing its way back, up 1.25%. There's still no deal between OPEC Plus and Angola and Nigeria. And the bullish bets on this commodity are the lowest since July. It's all about the art of compromise. Danny, good morning to Paris. Good morning to you.
Good morning, Manus. That market check was so good. I took a bite of my croissant. I had a snack while you were No, but look, I'm here in Paris for more than just eating the Bloomberg free croissants, which is definitely a perk. I'm going to be sitting down later with today Deutsche Bank's chairman at the OECD. That's Alexander Wynants. And Manus, we've been talking about banks a lot this week. We heard from UBS's chair yesterday talking about a bubble, an asset bubble in private credit. Does Alex have the same fear? Where are the risks in this financial system? It's something we are all trying to wrap our heads around with the fears of recession and rate cut bets stacking up.
Well, it's going to be a nice sort of classic European-Swiss head-to-head. Colin Kelleher yesterday, and you've got the president of Deutsche today. Where are we on the evolution of banking? How tough is it going to be next year? The only thing our clients want to know out there in Bloomberg land is where are you in terms of investment banking? What does the landscape look like next year? And are you ready to do more cuts? Because every other bank is either silently doing them on a drip feed basis, or indeed taking quite a swathe. Look at Barclays yesterday, Danny, £1 billion worth of cost they're possibly going to cut on the investment banking clients.
Yep, and $100 million to come from Nomura. Cost cuts coming there. The other thing this market, our clients probably want to know, is this bond market rally going to continue? Manus, you started with the show with this chart. I'm going to nip it from you. I'm going to steal it because it's a good one. We've seen bonds rally the most this month since 2008, since Beyonce was top of the charts. Manus will sing you guys the song later. But here we go. It's a big old rally based on the idea that the Fed is at peak rates and they're going to start cutting. Joining us now is Pooja Kumra, European rate strategist at TD. Pooja, what do you make of the pace and strength of this bond market rally? Can it endure?
So, again, a pretty strong pivot from Fed members yesterday, and basically markets have been reacting to that. And no one thought that we could see this rally in October when treasuries are close to 5%. Yes, it will be challenged in December as we go to the December meetings, especially given the fact that we need to know whether the Fed actually removes the extra dot that's in the dot plot, whether they will be hiking again or not. Whether central banks now believe that inflation will be at target when we come to 2024. So if you recall, as per the September forecast, all the central banks have said that their inflation target will not be reached before 2025. So I think that will be key for markets, whether Fed, whether ECB are able to downgrade the inflation forecast. And I think that is a key signal for markets that when are the rates coming. But clearly we are moving there, we are drifting there, and we are getting that. At least officials are entertaining the idea of rate cuts in 2024. But I think December is a bit too close to chase that entire change in dot plot or the forecast. I think March is the time possibly could get more clear signals as to whether we are close to rate cuts.
I mean, if we take our mind back to when global bond markets performed like this, it was 2008. Lehman's had gone bust. Rates were at zero, and the world was palpably a different place. Here we are with a yield curve that has just gone through a vicious Burr steepening, which is at the long end, which was about fiscal, it was about supply, it was about indigestion. And here we are pivoting to this bull steepening. Does that endure, and is that how you look at the curve now, the next evolution iteration? Look at those twos, they trashed them yesterday.
No, totally. It was like, even though we have had horrible auctions this week, we have rallied very strongly. So I think, yes, to your point, the trade for next year is possibly steepener. If central banks continue to entertain the higher for longer narrative, it's a bear steepener. But if they start entertaining cuts, it will be a bull steepener. So I think one way or the other, we are in that steepening criteria, and especially given the fact that the entire market participants have been short the front end, right? And I think that's where we could see that steepening move to continue. And I don't want to play against it, at least for now. I think if we do see very strong recessionary...
But why aren't, if I can jump in here, Pooja, why aren't these auctions mattering? They mattered so much just a month ago, and yesterday you pointed out, 7-month auction, little demand, it doesn't go well. This market doesn't care, it just focuses on Waller. Why is this evaporated as a concern?
I think markets, people have not got back from their Thanksgiving. So that's why I think it's more of a liquidity-driven thing, that I think we are still not back to the kind of cash volumes that we saw, that we see in a usual period. Markets have been extremely short, and there has been a change in narrative from Fed officials, right? We did not hear officials like Waller being that direct about we don't need more hikes. You know, that has really changed in a week's time. And I think that is something that, you know, when it comes to supply or monetary policy, markets will always go for monetary policy. Supply will be ignored. The moment Fed starts hinting more cuts, markets will actually chase duration, something that they have been running, away from the entire year. So I think there's lots of longs that would come in if we do continue to see this rhetoric from central banks. But I do feel December may not be the time that we can get that much clarity. Possibly it's more of a Jan-Feb thing where we see more slowdown in data, and that especially in the growth data.
It's interesting, you're the first guest in quite a while that has made a measurable mention about China. So well done to you. It does remind us, we got a headline this morning that there may be a shift in US-China defense relations. The OECD, I'm just looking here, the OECD says growth at 5.2% in 2023, 4.7% for 2024, and 4.2% in 2025 for China. You talk about the conundrums that we face, but perhaps, and I'm surprised, because a lot of people have said to me, oh, we don't need to worry too much about whether China exports deflation. The rest of the world will survive. We're not that worried about China in terms of its contagion impact. You are. You say that China growth really does matter to the conundrum of a desynchronized global cycle. Are you confident they'll hold 5%? What are they going to do to make 5% stick in China?
So I think when it comes to China, we have been seeing a lot of easing coming in, but it's been coming in more of bits and pieces. And that's because of the entire property sector. And I think there's too much pessimism around the economy. So we do feel that if you look at the entire fiscal situation, which basically accounts for almost 1% of GDP increase in fiscal issuance, that is likely to make its way through in 2024. And as you mentioned, we are actually above consensus when it comes to Chinese growth. We are looking for 5% growth, and which also means that will be an upturn for Germany as well, which has struggled a lot this year when it comes to growth just because of the China as well as the Russia-Ukraine crisis.
Pooja, thank you very much. That's Pooja Kumra with some pretty heady calls setting the stall out for 2024. Coming up in the show, Jack Ma calls for change. Why Alibaba's co-founder is looking to correct course in a surprise internal memo right here on Bloomberg. But of course, Danny, it is all about the direction of these yields and currencies.
It is. The dollar is recovering from its drop yesterday on those bets that the Fed would start cutting. Euro, that's been fluctuating. We had some weaker inflation data coming from both Spain and regional areas in Germany that's helping sink the euro. 109 is where we trade, with a yen at 147 per dollar.
On the next episode of the Business Week Show, imagination.
If no one else is going to buy and protect these buildings and make sure that people on the South Side have opportunity, is there something that I could do to try to acquire some of these buildings on my block?
You know, I feel really bad for young artists. They get swallowed up, spit out like stocks on the stock exchange.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
It's Global Bloomberg Brief from New York and Paris. With me, Manus Granny, and Danny Berger on tour in the beautiful city. Calling for a pivot. That is the top line in the corporate world. Jack Ma is urging fundamental change across Alibaba. It was an internal memo that brought it to light. Tom McKenzie is tracking the story. Tom, I mean, he's been out of the limelight, so suddenly we see a memo all about change of direction at Alibaba. Strategically placed?
Well, the fact that he has been out of the limelight, as you say, since around the end of 2022 and now comes in with this memo, this internal memo, well, that speaks and says a lot, doesn't it? And so he outlined clearly his concerns about what's been happening with Alibaba. He said, as you mentioned, that he wants to see and expects to see a course correction. And of course, this e-commerce giant in China. He talked about the opportunities around AI and the challenges around that as well. But he also really interestingly called out some of their competition, including PDD or Pinduoduo, which was once a scrappy upstart, less of a scrappy upstart now. In fact, its market cap isn't that far off Alibaba's, and he praised them and said they'd done a pretty good job. But for me, the fact that he's intervened, it came as a big surprise for employees at Alibaba, and I think it also really underscores his concern, Jack Ma's concern, about the direction this company is taking, the challenges it faces.
But why now, Tom? Why come out of the shadows and come into the limelight, especially after a period of the past few years of a Beijing crackdown?
Yeah, well, all of those challenges that we can unpack in terms of the economic recovery in China that's been much slower than people thought, continuing, of course, these companies like Alibaba to readjust to this new, more restrictive tech environment. And then the internal challenges as well. So the former CEO stepped down. They were planning to, as part of their readjustment and restructuring, to actually break the company up into 6 different parts. And there was a bit of relief from investors when they announced that, because there was a view that you could extract more value out of these 6 component parts, particularly interested in the cloud division. And then on their latest earnings call, they actually walked back that restructuring plan. So there's volatility within the company, within Alibaba, and then there's the external challenges as well. And we talked about that competition from the likes of PDD and ByteDance as well. And that has proven much more aggressive than I think many at Alibaba had expected. And this, I think, again, points to the fact that Jack Ma is deeply concerned, and he feels that he has the space, he has the time now to be able to intervene in this way, because he sees that this is potentially a company that is not meeting the challenges at the moment.
Interesting. Tom, thank you very much. That is Bloomberg's Tom McKenzie. All right. On Capitol Hill, congressional negotiators could be seeking to abandon plans to tighten controls on U.S. investment in China tech. Let's bring in Bloomberg's Alan Wan for more on this. Alan, what exactly is in this measure, and what happens if the House doesn't approve the measure?
I'm a bit surprised, just because this measure, which actually requires U.S. firms to actually notify the government, the U.S. government, if it invests in certain countries, such as China, countries of concern. And this measure had already been passed by the Senate, so we thought it was going to be a fait accompli. But it looks like the House Financial Services Chairman opposes this measure on philosophical grounds. In terms of who benefits, I mean, maybe I would say the winners are Wall Street and these PE and VC firms, right? They're the ones who oppose these broad investment restrictions that would prevent them from investing in some of these high growth areas in China, such as tech. But also very controversial, because you talk about chips, AI, and quantum computing as well. And then you have like these VC firms like Sequoia are already kind of like preparing for this eventuality. They already started like separating out their U.S. and China businesses into different entities as a prelude to the passing of this measure. So we're going to see what's going to happen next. So if you're not going to get this, what are we going to get instead? Probably a more narrowly tailored approach. We're talking about maybe targeting individual companies for sanctions.
Alan, let's ask ourselves the fundamental question. I mean, we've seen Blinken in China, we've seen Treasury Secretary in China, we've seen Xi Jinping here, slight faux pas by Biden at the end. But this is a demonstrable shift in the Biden administration in terms of their perspective. Is this a result of the soft power initiatives that we've seen?
You know, I would say yes, except the fact that, you know, the Biden administration already passed an executive order back in August that sort of is already going to regulate investments in, you know, PE investments in Chinese technology. You know, it would have been a much more aligned approach with Congress, a broader broad approach to targeting, areas of concern. But instead, now it seems that the Biden administration is on its own, and what you can get instead is probably a more narrowly tailored, softer approach to preventing U.S. companies from investing in high growth but also controversial areas of the Chinese economy. And we're not just talking about capital. I mean, a lot of these VC and PE firms also bring technical know-how.
Right. So then, Alan, if this is shut down, then if this is batted down in the next portion of this vote, if it doesn't get through Congress, what happens next? Does this open up the floodgates for that type of investment in China, or are there still more hurdles?
Yeah, like I said, I think that you still look at the Biden executive order that's supposed to be implemented next year. I don't think that it's going to go away, but I think a lot of the hawks in Congress, people like Matt Gallagher, are incensed because it allows, if let's say you have a more tailored approach targeted companies, they're saying there's an issue of whack-a-mole where you sanction one company, one tech company that's a bad actor, but then another tech company does the same thing. It's a bit of a whack-a-mole. So it's not going to I mean, China might see it as a little bit of a softening, but by and large, it's hard to say that just because there are measures being already be implemented to sort of regulate too much U.S. capital from flowing into China.
Alan, thank you very much. Setting the agenda there, Alan Wan in Shanghai. Coming up with Danny and myself, some of the market-moving events for the day for you to keep an eye on. We've got a little bit of data flow from the inflation side in Europe. What next for these bond markets? Equity markets are lit up this November, up over 8%. As the short end of the curve drops, equities are lit up. From New York, good morning. What have you?
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
It's Bloomberg Brief. Danny Berger in Paris, Manus Cranny in New York. Let's get you set up for your trading day. Here's a look at what's ahead. German CPI, that will hit at 8 a.m. Eastern time. Then it's U.S. GDP, core PCE, wholesale inventories, all at 8:30 a.m. We're also going to hear from the Bank of England Governor Andrew Bailey at 10 a.m. Eastern. Plus, the Fed releases its beige book at 2 p.m. But, Manus, it's been the talk of Waller, who usually is a hawk, saying that policy is okay to hit 2%. That's really what's been captivating the bond market over the past 24 hours.
Not just about that. I think the framework that he gave us to work with yesterday, in other words, calling, in 3, 5, or maybe even 6 months, that inflation coming back to trend. Now, that potentially pulls forward the first cuts. The market's got 100 basis points priced in, 80% probability that it comes a little bit earlier. So I think that momentum, these bond markets are lit up early for Christmas, and they are rocking it out. And you've got German inflation coming a little bit better in some of the regions as well. So that adds to this momentum, doesn't it?
Yeah, well, you know what's certainly not lit up? Stock market volatility. Manus, this thing is so sleepy.
Repressed.
We hit the lowest since before the pandemic. We hit the lowest since before the pandemic last week. We're still hanging around those levels. Someone wake this thing up, Manus. Even Goldman says that you should be buying hedges. Now's a perfect opportunity, they say, to jump in.
Well, this is the debate, isn't it? I mean, Mark Hayfley also over at UBS. Let's have a look at the VIX chart in terms of that repression. And you can see it really, really is way down there in the sub-12, getting towards that 12 level. Hayfley says now is your opportunity to step in and pick those up. Because if you just think globally, equities are up 8.8% in November. And Goldman's actually, when they're talking about that hedging, they're saying we've got an inverse Goldilocks scenario for the US. Faster than expected inflation normalization, and growth remains resilient.
Yeah. Well, Manus, we have a little bit of macro movers worth to micro movers just quickly move through. Farfetch, Richemont says it has no plans to lend or invest in it. The Telegraph had reported that Farfetch plans a take private deal. So that's a move there.
I just want everybody to know that I have evidence, right? This is what actually happens in the commercial break. Look, you see, do you know what she was doing in the commercial break? Let me just show you. She was eating croissants.
Do I still have crumbs on me?
Yeah. She gets croissants.
I mean, I gotta give myself fuel, Manus. I gotta keep up with you. I gotta fuel myself with a nice
This is an unfair world.
All right. All right, you can catch me later, 11 a.m. New York, speaking with Deutsche Bank's chair on Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
This is Bloomberg.
At this period in time on the timeline, this looks like a great time for investors in equities.
I would definitely still be long treasuries between now and the end of next year, but with a nod to the fact that it will be a choppy ride.
What I find the most concerning about the last month is there's been a massive risk-on rally on weaker economic data.
We are now starting to see lots of different things trickle into the economy, which will make the economy likely fall over next year.
I think it's incredibly important to remain invested, even in times of uncertainty.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get straight to it. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 positive by 1/3%. A major move again in the bond market. TK, Treasuries advance, yields lower. We're ignoring Governor Bowman. We're focusing on Governor
was
Waller.
that something? I mean, it was really important to see that, the differentials here of governors and presidents and which ones matter to the market and all, but it was a real jump condition. The first thing I looked at this morning, John, was the different technical construction of the market. I didn't realize how much we'd surged higher. I completely have missed the idea that we really haven't broken support. Katie Kaminsky yesterday nailed it. We could still go higher in yield because technically we really haven't rolled over yet. You look at Kaminsky yield and this fancy phrase technical support, we're coming down. We're getting right near that tip point where we decide lower yield or higher yield.
It's a 70 basis point move in about a month.
Yeah.
Let's go through the numbers. We went through 5%. We're down to about 429. We're down another 3 basis points in the Treasury market. This is a change for Governor Waller. Super hawkish. Now he's basically suggesting to the market he's done and some. Something appears to be giving. Bramo, his words, and it's the pace of the economy.
Yeah, he said if we see disinflation continue for several more months, I don't know how long that may be, you could then start lowering the policy rate just because inflation's lower. He's saying the unspoken words that the Fed didn't want to entertain, which is entertaining and discussing rate cuts at a time when you're still seeing a robust U.S. economy.
And Bill Ackman with his David Rubenstein interview, a lot more on that in the coming days and weeks. John, he went to the real yield moments ago. I got a 206 handle, 2.07 right now in the 10-year real yield. Could you imagine a 199 real yield and what that means for the likes of Professor Waller?
Attention turns now to Chairman Powell this Friday. Let's see if he endorses some of the language that Governor Waller used yesterday. Intriguing, Lisa, to your point, that we ignored Governor Bowman, who's saying something totally different, and focused on Governor Waller. It tells you something about the bias of this market at the moment, doesn't it?
It tells that people are focused on disinflation. They're focused on figuring out just how soon they can declare victory for the Federal Reserve, that they've achieved their soft landing. And it fuels this feeling that everyone got it wrong, that they actually were able to achieve a soft landing this year. Maybe, if we did. So maybe lean into that for next year. Again, though, does that tell you more about sentiment than the actuality on the ground?
Running counter to this slowdown story in the economy, retail spending in America, record shopping, Black Friday into Cyber Monday, going into the holiday season. What matters more, how much the consumer in America is spending or how they are spending? Buy now, pay later. Some of the stories out there in the last 24 hours. This from the Journal. A 43% surge
from last year, according to Adobe, Lisa, in buy now, pay later options?
I was thinking so much about this week because I saw the 14% surge just year over year in terms of Cyber Monday and the buy now, pay later. Number one, how much is this younger individuals who feel disenfranchised or don't want to participate in credit cards, right? That is one aspect of this. The other aspect of this is you see something, you like it, you buy it, you don't think about how you're going to pay for it over the longer term, and how much it sort of fuels the ability to keep spending even beyond someone's means.
Yeah, I mean, if you look at a refrigerator, John, I mean, are you going to do buy now, pay later on a refrigerator?
We'll ask the question
put it on there at 28%.
Did we do buy now, pay later, or did we pay cash?
We paid cash.
We paid cash.
There
They
we
paid
go.
cash at Casabramo.
The Calvinist theory with Lisa Abramowitz. There it is.
Lots of people did not. Lots of people did not. They reached for buy now, pay later options. Payments company Block, this again from the Journal, saying that sellers using its Square and Afterpay platforms registered a record 70 million transactions over the Black Friday and Cyber Monday weekend, up 14% from the previous year. Reported a 19% increase over there in buy now, pay later purchases made through Afterpay. So, Tom, you've got data from Adobe and data from Block there, backing up the same story. There was a lot of reaching going on over the weekend.
On a digital space and the digital future of banking, they're having meetings today about what do we do. I don't want to be dramatic, the death of credit cards, no, but people are revolting against 26 and 28%.
We'll come back to this story in just a moment. Here are the scores. Equity markets look like this on the S&P 500, positive here by 0.3%. Yields a little bit lower on a 10-year again, 429.36. Lisa, the 2-year down 3 basis points. It's a break of 470 on a 2-year. The middle of October, for what it's worth, we were looking at 525, 526. We're back down to the 460s on a 2-year.
To see the benchmark bond yield in the United States fall by a percentage point in just the space of weeks is really quite shocking. And this perhaps is why the story of disinflation, or rather the mystery of disinflation, how far we are in that process. At 8 a.m., we'll get the latest read over in Europe. Germany's headline CPI, headline price inflation is going to come out. And this is going to feed into tomorrow's read in the rest of the Euro region. How much are we seeing this in a way that's sustainable? Earlier today, we got Spain's CPI, and it came in lower than expected, but still 3.2% above the expectation. At 1:45 p.m., you know, yesterday I was kind of dismissive about Fed speak and how much they could actually move the market.
You weren't alone. So was I.
And I was completely wrong. And I wanted to say that because Chris Waller absolutely moved the market. Do people pay attention to Cleveland Fed President Loretta Mester when she's speaking about financial stability? If she says anything other than leaning into the idea of rate cuts next year, kind of to the point that we saw yesterday.
Apparently we'll listen, Lisa, if they say what we want to hear. That seems to be the takeaway from yesterday for me.
Which maybe is the reason why at 2 p.m. when we get the beige book from the Federal Reserve, how much are people going to look at anecdotes highlighting that slowdown that we heard from Walmart's CEO?
Really?
Which really has been the reason maybe that we have seen the U.S. Economic Surprise Index fall to the lowest level since April of this year. I'm just going to keep talking.
Victory Lab.
I don't know who he's talking about.
7-year auction. John, Victory Lab, Bramo,
again.
7-year auction.
No, actually.
You did it again. I mean, there it was.
It was, but it actually wasn't that good.
And then it came
no one
back.
cared.
It was like, why is that? It spiked up, world's coming to an end, and it came right back down to where it was before. Why?
Because a failed auction didn't fit the narrative of the day.
Okay.
I'm with Bramo. I'm totally with Lisa on this. Governor Bowman says one thing, open to more hikes, thinks that maybe base case we need them. And Governor Waller is basically saying we're done. And we're putting more weight on one voice than the other. And I get it, it's a shift from Governor Waller. I understand that. It's a shift from where we were maybe 12 months ago. But there are still some voices out there, Tom, pushing for something different.
People in the backstory here, and this is with great respect to Ms. Bowman, people have an immense respect for Mr. Waller, academic respect. They really, he walks in a room, people take notes.
Tell us what you really think.
Yeah, no.
Hey, we'll have this conversation a little bit later.
Nice
Joining us now, Christian Knowlton, Global Chief Investment Strategist over at Deutsche Bank Private Bank. Christian, I want to start with the retail sales through the weekend, the holiday spending here in America. What matters to you more, how much consumers are spending or how they're spending?
I think timing-wise, of course, short-term, how much, which is positive, but then I think you have to pay the bill, right? And you talked about pay now or pay later. I think as we are saying high for longer, the bill is higher probably for the consumer than some people might think. So from that perspective, something to be watched.
Christian, in your note, your view forward note, you have a magnificent phrase which really sums up the angst of the moment. You are in search of 10% growth. How do we find 10% growth next year?
Well, I would say in general we are in search for growth because we do expect economies to grow at, let's say, slightly below 1%. That's true for Europe, that's true for the US. You would only see higher growth rates in China, India, where you have sectors where there is more than 10% growth, even on single companies. They should do very well in this environment. And you have seen some sectors where this is continuously the case. And I think in the environment we see for next year, that should still give us some quite decent performance.
Your outlook calls for 175 basis points of Fed rate cuts next year. It talks about how it looks like something a bit harder than a soft landing. And yet there is this optimism around equities. This is confusing. How do you put these things together?
So I think the outlook comes to 175 rate cuts in case of a severe recession. I think that you have to also look at the other side. If there's no severe recession, I would say it's rather a mild recession. Then we probably get 3 cuts from the Fed and also from the ECB from our point of view. And so it could be a more volatile beginning into the year, and then it should calm down. And if you think of volatility, and Tom, we talked about this last time, bond volatility is still higher than equity volatility. I think equity volatility is priced for soft landing. So everything which gives us concerns on growth would probably also increase equity volatility. That could happen maybe at the beginning of the year, but should calm down in the second half.
Who's right, Christian? This idea that we're seeing this massive deceleration in the consumer, the fact that we heard from Walmart, the fact that we heard from Target, the fact that you see the economic surprise.
How are you today? Hope you're doing well. I'm placing an order to sell short Bitcoin. Okay, so all of you guys who want to sell Bitcoin and copy my trade, the price I'm looking to sell 38,000. Let me now tell you 79. Let's place 38,079, and let's wait until fill this order, and then I will let you know what I'm going to do next. Okay, guys? Speak to you later. Stay safe.
Potential rates, I think there's no way not to own America, right? If you look here in Europe at potential growth rates, it's, I would say, substantially lower than in the US. So I would be surprised if you see a decoupling of Europe from the US. Especially, there's a lot of discussion about valuations here in Europe, which look very, very cheap compared to the US. But I think it needs to find a trigger that people look into Europe. So for the time being is really about owning the US, and I have not seen that trigger to move to Europe at this point in time.
Christian, there just seems to be a radical difference in the transmission of monetary policy, the channel to do so in the United States versus Europe. I was looking at the bank lending data, credit data in Europe. Just how challenging, Christian, are things in the European economy right now?
If you just look at the growth perspective, right, we are literally in the same number for Europe than the US. Just saying the potential growth rate is stronger in the US. And if you look at the composition of indices, S&P versus, for example, Eurostoxx 50, much more on the growth side towards the S&P, much more probably on the value side, more export oriented. So I think it's a different composition of growth. In terms of China getting stronger, that would be positive for Europe. In terms of lower yields, that's rather positive for growth, and that's probably more positive for the US.
Interesting. Christian, thank you, sir. Christian Nolting there of Deutsche Bank, private bank, on the outlook there for the United States versus Europe. US exceptionalism in the equity market has been a major theme, Lisa, for all the hopes and dreams of international outperforming. Luxury in Europe faded pretty quickly. We were talking about the miners and China reopening. That story faded pretty quickly. Here we are talking about the Magnificent Seven at the end of the year on the US equity market.
I guess that the one real takeaway from 2023 is a story of artificial intelligence dominated and grew through the year, with people building on it in terms of its application and potential productivity gains. So if that's the case, people kind of lost interest in the luxury story. People kind of lost interest in the mining story because China underperformed. I'm waiting for people to lose interest in the Ozempic story because a lot of people have said it's gotten overplayed.
I refuse to. I love that story.
Why do you love this story?
I love that story. I just think that a pillar of this economy in America is built on obesity. That when you're looking at a country that's made up of a third maybe pushing 40% of the population is obese. Think about the changes you could have off the back of that drug. I think it's that big. Number one killer in this country, I think, is heart disease, right? Imagine if you start to change that, people start to live longer, where the money starts to get spent. If it can do more for things like addiction, say beyond obesity, to gambling, all kinds of things. All kinds of things.
I don't disagree in terms
again
of the
and again
scope
and again.
Of it. Yeah, I don't
I think it could be
disagree with
huge.
the scope of it, but the question is, I believe it's rather expensive. Who's going to pay for it?
$900 a month. My question is just side effects, number one.
Sure.
Number two, who's going to pay for it? And number three, the sustainability over a longer period of time.
Exactly.
But you're right. I think it's transformative potentially.
For many, many sectors.
Why are you
many
looking
sectors.
at me?
I'm not.
You're looking at me.
I'm not.
I mean,
it's not
Grandma's
personal. It's
Grandma,
not
did you
personal.
do 10 or 15 miles
It's not personal. Equities on the S&P, positive from New York. Good morning.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Of course, we will be talking about the crisis in Gaza and the broader Middle East. I'm very pleased to see hostages returning home, coming back to be with their loved ones. And we're determined to continue that for as long as possible to bring as many people home as we possibly can.
That was US Secretary of State Antony Blinken speaking earlier today in Brussels as he attends a two-day NATO meeting. Blinken is set to make stops in Israel, the West Bank and the UAE in the coming days. Live from New York City this morning. Good morning to you. The scores look like this on the S&P 500. We are positive by 1/3 of 1%. Yields lower again. It's a break of 430, guys, on the 10-year. 428.59. We're down 3 basis points. Lisa, only a month or so ago, through 5% on a 10-year and a conversation about 6, maybe even 7. The never-ending bond market sell-off, and here we are. Crash landed.
I think that even we heard 8% out there thrown as a theoretical number that was not unreasonable. We're looking at a situation here where people have whipsawed back down to disinflation and buying in. So the question is this the final move, or is this just the latest episode in a very dramatic whipsawing year, right? And honestly, this is a serious question, especially given the fact that you have the likes of Andrew Hollenhorst talking about underpinning inflation that's going to resurge early next year.
And the derivative guys, all the year-end views of various quants has told me that they're looking at collared trades. They're looking at this way or that way. Nobody's really calling a direction. They're saying, hey, here's the setup to go to lower yields. Here's the setup to go to higher yields. And that was really stark yesterday between Katie Kaminsky looking for higher yields versus many, many others looking for a trend here below 430.
What is the bet for next year now? What is it? Below trend growth?
The bet is,
no
the bet is we'll be here.
We get rate cuts and we don't see much damage to the labor market. Is that it?
I think I don't know what the consensus bet is. The bet is to stay and hang on every data point. We're going to do that today with a second look at Q3.
The bet is it doesn't matter what your economic outlook, stocks will do well in the U.S.
It seems to be that way, right?
Exactly. I mean, that's
Just
basically
looking at some of the calls.
Seems to be the
It takes
consensus.
a while to form consensus. We were talking to Laurie Calvasino of RBC about that earlier this week. It just feels like consensus has quickly coalesced around this view that below trend growth but no recession, rate cuts are coming, and ultimately it doesn't matter if you do get that recession, stocks are okay.
Yeah,
That's like the consensus view.
100%.
Yeah,
Ranges
I
like
agree with
4,700, 5K, 51, something like that.
I'm less focused on recession and more on what nominal GDP is going to do, and that's got two moving parts, the inflation part and the real GDP part. And I take the point. It's wildly open to review, and that's this data dependency.
Okay, guys.
We've also got data dependency looking at the politics
We're
of the
open
nation.
short position.
Joining
All
us
of
now,
you
Greg
guys who
Villiers,
wanted
Chief
to
U.S.
as
Policy
well,
Strategist,
go to my
AGM
page and
Investments.
follow me.
Greg, I got
Stay
8 ways
with
to
me.
go here with the
As
different
soon
narratives that are
as,
out there.
it
Let
will
me just
start
start as we
moving
just saw
down,
the Secretary of
we will
State
place
doing
stop
what
loss
Henry
on it,
Kissinger used to
and
do.
we will
Do the Republicans have a foreign policy?
for
They're
decent
divided,
profit.
very divided on
Just
foreign
want to
policy,
remind
as
you
Nikki
that
Haley and
as
others
you
have shown between hawks and people
just
who are
want to
more
remind you
isolationist.
that,
The good
when we
news
trade
is that
for
we have
quantitative
established
equals
lines of
100
communication
pounds
between
in
Israel
Bitcoin,
and
because we
some
trade
Persian
on
Gulf
margin, we
countries,
trade
with the U.S. and others being
derivatives.
intermediaries. The bad
With
news is, and this is
Bitcoin,
getting worse
it
by the
equals
day,
to
I'm not sure about
1%,
aid to
1,000
Israel,
pounds.
Ukraine.
Okay, guys?
That's starting to
I'll speak
slow
to you
down in
later.
Congress.
Stay safe.
Nikki Haley has a lot of here. She is the 29th United States ambassador to the United Nations. How foreign is Nikki Haley to Republicans?
Well, to many Republicans, she's viewed as not a preferable candidate. The thing, Tom, that strikes me is that young conservative Republicans are indifferent to aid to Israel or Ukraine. I think it's a great mistake. I worry a lot about Iran. I worry in terms of Ukraine that Putin could start thinking about Lithuania, Estonia, Latvia, other places to invade. This is a real threat, but I sense isolationism is growing in popularity in the U.S.
Greg, to that point, there was a poll by the Harvard-Harris organization that came out. It was written in a Wall Street Journal article yesterday showing that roughly half of Americans aged 18 to 24 years old think that Hamas's October attack was justified by grievances of the Palestinians. And they talk about how they are looking for not only a ceasefire, but feel like there's a real tit for tat. Just 9% of people age 65 or older feel the same. Greg, how much is the divide of the generations wider than it has been in the past?
It's a really big deal, Lisa, and I think it's not just on this issue. It's on student loan relief, it's on guns, it's on immigration, it's on a wide range of issues. And I think for the White House, it's astonishing now to see that among that young group you cited, Biden trails slightly. He won that group by 20 points in the last election. If it's tied, he loses.
How much, Greg, is it something that he wants to cater to versus just shrug and say, well, they're not going to show up anyway? I mean, at what point are these voting individuals in the country versus people who are being active on college campuses and social media but feel kind of marginalized, frankly, in the political sphere?
Yeah, it's the marginalized people is a puzzle the White House can't solve. The marginalized people think the economy is terrible. I would disagree. And it poses a real threat to Biden's reelection.
I got to go to the news over the weekend, Greg, and the thundering silence of the GOP in the Senate over their candidate going after something 13 years old. That's the Affordable Care Act. Obamacare. I was really just the divide there between what President Trump desires second time around versus his team. I believe I've never seen that, Greg.
It was a remarkable development. In sports, we talk about unforced errors, and this was an unforced error. I think that Trump is a loose cannon on a lot of issues. A lot of veteran members of Congress were like, what? He wants to reopen Obamacare? It's settled. The public likes it. It polls well. There's no alternative. Yet Trump wants to raise the issue. I think that would be disastrous.
Totally unfair, Greg. What's the first 100 days of a Trump administration look like?
Vengeance. Vengeance more than anything else, Tom. I'm not even sure what his agenda is.
Oh, we got Greg Friesen. Greg's
I
Friesen.
think he wants to get back at people who have slighted him. I think he wants a Trump. I think that is going to be the biggest concern.
Hey, Greg, got to leave it there. Apologies about the technical problems towards the end of the conversation there. Greg Valliere of AGF Investments. I was slightly distracted here. Sometimes the title of Southside Research really catches your eye, and
yeah,
that is why you open
what
it and
a
read
game.
it. This from the FX team over at Wells Fargo. Goldilocks and the Five Bears. Do you want the Five Bears?
Please.
Okay. So base case is weaker dollar into next year. I'll give you some of the bears, okay? We caution against extrapolating out the dollar's near-term weakness too far into 2024. A realization of a broader global slowdown could take place in the first half of next year. The prospect of significant rate cuts, lingering China weakness given structural issues, rising global geopolitical risks, and drum roll for a fifth one for you, a heavy 2024 election calendar. Next year is a big year. It really is.
Yeah, it is. And by the election calendar, John's talking about global elections, the many elections worldwide, and we sort of stagger from one to the other to the next. But it does speak to, you take the IMF gloom out there and where global GDP is going sub 3%. All sorts of bad things happen with sub 3% global GDP, which means what do? You buy the dollar. So maybe it's not strong dollar, but maybe it's dollar resiliency pushing against the consensus.
Maybe the Five Bears are the reason why there's very little conviction other than buy stocks because tech is still going to take over the world. I mean, essentially, is that the reason why we're seeing people come out with varying prognostications about the economic outlook, but the same one when it comes to Amazon and Apple and Google and OpenAI and Microsoft?
Sam Altman.
There we go. Line them up.
Mention Sam Altman for 5 minutes.
I just
Talk
wanted
about
to.
Sam Altman,
That's
OpenAI.
Well, I mean, honestly, this is sort of the story that, you heard Mike Mayo yesterday talk about it, about how this is going to really fuel bank earnings with some of the efficiencies there.
I think Charlie Munger was right on it. AI, there's clearly going to be some winners, but can you imagine the number of losers who go into a concept of AI without the intellectual authority that we're seeing out of, Microsoft and others? John, I think what we can establish here as a trend for next year is if you got 5 bears at Wells Fargo, we know where the 6th bear is. There's just no question about it right now. Bramo is the 6th bear.
Bramo's consulting over at
Put
Wells.
on my suit, show up at the holiday parties. I'll tell you my glue scenario.
I'll show you. They're thinking they're going to have a nice drinks, warm moments, some canapes maybe. For the holidays, talk about Christmas and
the 6th bear shows up.
Your plans, and Bramo shows up. Let me tell you about your call for next year. 5100, I don't think so. TK, you mentioned Charlie Munger, the late great investor, partner to Berkshire Hathaway's Warren Buffett. We're going to spend a bit of time with a tribute to the man himself.
I'm so honored that Doug Cass has found time for us today. Doug Cass knows this tandem like nobody.
Doug Cass coming up later this morning. Howard Marks of Oaktree as well. Big conversations on Bloomberg Surveillance.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Some people might say that insurance is a boring business, but is that not the case?
No, I find it very interesting. I mean, you're not doing the same thing all the time. I liked it because it had a balance of doing different things at once.
Actual quote, Bramo, commercial break. I'll be happier this segment. Actual quote, verbatim.
The context. The context.
Well, you can share the context in a moment.
Okay.
Equities on the S&P 500 positive
For next year, we're doing big little.
by 0.3%.
You're going to see us on the break.
Live cam of Bramo in the commercial break with audio.
She ignores us, just so you know, folks.
Equities on the S&P
like
down a third of 1%, or rather up a third of 1% this morning. On the Nasdaq 100, up 0.4%. Yesterday, the stock market pushing out a small day of gains. The rally in November stalling out, I have to say, recently, Lisa, over the last week or so.
Yeah, really, I think that there's a little bit more recognition that bad news is not necessarily unmitigated good news. And I think that there is a feeling, a concern about what some sort of slowdown could percolate into.
Still on course for the best month of the year on the Nasdaq, quite phenomenal. Off the back of this move in the bond market, 2 year. Let's just sit on a 2 year, front end of the curve. This yield, mid-October, mid to late October, 526.
Wow.
469.71. Down another 4 basis points. And this bond market yesterday, choosing to listen to Governor Waller much more than choosing to listen to Governor Bowman.
Like at different levels, they're technically 4.14, even a 4.04. But John, to the addiction of equity markets up, and all of that since Halloween is the basic idea that we've really at stasis. Have we rolled over? I don't see any violation of moving averages here. We're just noodling along, waiting for the next news.
It's the psychology of
more
the top.
7 stocks.
So think about it right now. You've been telling clients for a while, consensus view on Wall Street, lock it in. Lock it in.
That worked out.
They're worried about the reinvestment risk a year from now. If you are sat in T-bills and you maybe sit here 12 months later, will you be happy you have dry powder to allocate to the equity market, or disappointed that you didn't go further along the curve and lock in this yield? So when you get this move from 5% to 430 on a 10-year, Lisa, all of a sudden the attitude starts to change. Only 30 basis points from having a conversation about the threes, then people really start to feel like they've missed out on locking in 5 for a whole lot longer. And this just feeds on itself. In either direction, by the way, every time you have a 50 basis point move in one direction to the other.
Which raises this question, are we going to see next up sub 4%, or is this going to be the trade, the collar that Peter Scheer was talking about, 425 to 475, and bouncing around from one to the other as people's moods shift depending on the data and the wind and the bears?
Well, to your point, the conversation just changes radically from one 50 basis point move to the next.
Yep, pretty much. That's
and if you
basically
ask
right.
people in fixed income, where do you believe the next 50 basis points is, lower or higher? I kind of struggle to answer the question, Lisa, going into the start of next year. If you give them a 12-month view, where do we land? They'll say lower yields. Lower yields. But tell me where the next 50 is. Tell me where the next 5% in the equity market is. Give me a tactical, Tom, tactical call on this market.
Tactical call, I can say, is the momentum's there in 7 stocks, and you got 493 others, including Generous Motors, that maybe aren't there. What Mr. Munger would say, and Mr. Buffett this morning, is use of cash matters, and maybe that's how you get Christian Nolting's 10% growth.
Let's get to your top stories this morning. Under surveillance, Charlie Munger, the man who built Berkshire Hathaway alongside Warren Buffett, has died. Buffett paid tribute to Munger, saying the company, quote, could not have been built to its present status without Charles's inspiration, wisdom, and participation. Munger served as Berkshire's vice chairman and was one of its biggest shareholders. Charlie Munger, Tom, was 99.
99, a long and wonderful life. And to me, and I said this to Nathan Hager in radio here in the last hour, the singular feature, and I was a young kid, was the shock of 73, 74. He was formed by big double-digit negative losses in what I call it the Pittsburgh recession. It's when Pittsburgh evaporated. But 73, 74, he lost